throughout this earnings season. There is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations. Investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It doesn't feel like we've had a weekend for about a month, but let's attempt to anyway. Let's get you to the weekend. From New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, heading towards another week of losses on the S&P 500, a third week of losses. On the Russell, we're looking at a third week of gains. Check out the future right now. The futures board on the S&P 500. We're up by 0.75% on the S&P. On the Nasdaq 100, we're positive by 1%. The outperformance once again on the Russell 2000, the small caps up by 1.5%. The stat of the month comes from Jim Reed at Deutsche Bank. The Max 7 down nearly 13% since the record high back on July 10th, with the Russell and the small caps outperforming, Lisa, by a remarkable 24 percentage points over the period.
That statistic highlights the ultimate question underpinning what we've seen over the past 3 weeks, which is this a gloomy sell-off on the heels of some sort of growth scare, or is this a really healthy kind of growing pains related to a sort of positive transition to some of the more leveraged stocks to the economy? That ultimately is the angst underpinning what we've seen.
Yesterday was a super messy session, and we'll be talking about that mess throughout this morning. We need to talk about the economic data. PCE a little bit later on this morning. Yesterday, jobless claims. You just got the sense from a lot of people that claims were the difference between having time and running out of time. And there is a belief based on claims coming in a little bit better, GDP coming in firmer than expected, that we have just a little bit more time. Companies are saying something very different though, Lisa. Big airlines are warning about airfares. Automakers like Stellantis are struggling with sales. You go through the top and bottom end of the consumer. The world's largest food company, Nestle, cutting its outlook. Even the luxury players like LVMH and Kering are coming out and saying, you know what, I think we've got a bit of a problem.
The problem for market participants is understanding if this is a problem with margins, if this is a problem with consumers that still have money but are being more discretionary with where they spend it, and actually just an incapacity to spend. It's two different things, because you also had Hermes, evidently Birkin bags are just fine. So on the flip side, it's sort of selective spots that are doing just fine while everything else kind of struggles. You look at going forward, and it seems like we're moving to a point where September is a lock-in. July is out of the picture. Next week is out of the picture. But ultimately, there is a distinction between preventative rate cuts and reactive cuts. And the market is coalescing around the idea of preventative rate cuts in September, which could be less of a negative than reactive cuts to true deep weakness.
Don't you think the Birkin bags are like their own universe?
Yeah.
Got low end, high end, and then you've got Birkin bags.
Maybe it's the people who buy them are in their own universe. Maybe that's part of the distinction.
It's like 50 people on an expensive island somewhere who can afford them. Equity futures on the S&P look a little something like this. We're firmer by 0.75% on the S&P 500. This is your bounce back from a really volatile session yesterday. In the bond market, the 10-year 423.28, and in foreign exchange, the euro at just about 108.50 and positive by almost 0.1%. Coming up on this program this hour, we'll catch up with Ben Laidler of Bradesco on the Great Rotation. Tobin Marcus of Wolfe Research as Trump and Harris debate the next debate, and former World Bank President David Malpass ahead of Treasury refunding next week. We begin with our top story, the Great Rotation gathering some momentum. The Nasdaq starting down a third week of losses, with the Russell looking to make it 3 weeks of gains. Ben Laidler of Bradesco writing this is the longer-awaited bullish rotation in markets, not the start of a broad correction. This broadening is key to the sustainability of the bull market. Ben joins us now for more. Ben, let's get there. First of all, as we stare down a third week of losses on the Nasdaq. Ben, tell me what you look at to distinguish between something bad and something good when you see price action like this.
So the tectonic plates of this bull market are absolutely shifting. That's unleashing some tremors, but this is a rotation, not a sell-off. The equal weight S&P is up over the last few weeks, even when, as you mentioned, big tech is in this fairly significant correction. And I think this is emblematic of what's coming. Markets are looking at the assets which are most sensitive to the economic soft landing and interest rate cuts. And small caps is just the canary in the coal mine here. That's why it's reacting the most violently. But it's also, I think, a reminder of how a little bit of money can go a very long way in all these assets, whether they're in the rest of the world or all these other sectors, which we basically forgot about over the last few years as this sort of one-legged big tech bull market sucked up all the attention.
Ben, let's dissect it. Let's dissect this mess over the last couple of days. You identify three different things. What's driving it? What's amplifying it? What's globalizing it? Can you just go through that point by point?
So, big tech's had this massive rally, valuations, obviously high. Everybody's built up on AI, et cetera, et cetera. Any sort of disappointment, and maybe we got that from Google, just amplifies the angst which is already out there, and people that were looking to pull those triggers pulled those triggers. I don't think that means that tech's a bad story, though. Tech was doing very well before AI. Tech doesn't need AI. It's just maybe things got a little bit frothy. But this is 30% of the S&P 500. Concentration is very big, and that unleashes some sort of volatility. But at the same time, we have data which we saw yesterday, which I think validates the soft landing. We have a Fed which is getting ready to cut in September. This is pouring gasoline, I think, on looking at those assets which are most sensitive to that scenario. And that's not big tech. That's everybody else. And then thirdly, the US has just got so sort of supersized that any stumble, I think, reverberates around all assets. And that's the cost, I think, that we've taken in many parts of the world. I'm sitting here in the UK over the last couple of weeks. But I think that will fade. And I think actually many of these assets, whether they're emerging markets or Europe, are in this sort of same bucket as sort of small caps, which will do very well in this new environment, and where a little bit of money will go a very long way.
I love that a lot of people come on the show and they have vastly different appearances in terms of their outlooks, and then you start talking about their time frames, and it turns out that they all have the same view. It's just sort of depending on where your time frame is. What is your time frame for this great rotation and this sort of wonderful outcome, given the fact that over the short term, there are a whole host of different analysts, including Julia and Emmanuel, who see this continuing on a technical basis, who see this continuing potentially if we don't get massive beats from big tech next week?
Yeah, so ultimately, the fundamentals matter. And I think the fundamentals sort of support this rotation. Tech is not growing earnings, or big tech, 70% anymore. It's still great. It's going to be 40 to 50, but absolutely it's a consecutive slowdown. And at the same time, everybody else is no longer in an earnings recession. Those earnings are consecutively recovering. And I think we have visibility on getting back to double digit by the end of the year. So I think this rotation is very fundamental. I think it will happen reasonably slowly, or at least I hope it happens reasonably slowly, because what we're seeing right now, I think, is just the big tech has got so supersized that when it stumbles, it spews volatility everywhere. We have the VIX now, back at long-term average levels. So, I'm a little bit scared of the very short term, but I think this rebalancing of the economy and of the stock market will hopefully be a moderate that plays out over time. And remember, we've been waiting for this for a very long time.
You said fundamentals matter, and you're talking about how smaller companies should really benefit in this kind of environment and have been sort of thrown out with the bathwater. How do you understand Ford? How do you understand Stellantis? How do you understand American Airlines and Southwest and all of these different companies, consumer-facing companies that are coming out and saying, actually, things are getting worse than we thought that they'd be, and we cannot pass on our price increases?
Absolutely. And this is why I think, there are going to be plenty of idiosyncrasies out there, right? There are 500 stocks in the S&P 500. But I think overall, as we saw yesterday, the consumer continues to be in pretty good shape, incrementally slowing. Demand. This is not a demand story. This is a story where demand is okay, where profit margins are getting a little bit of relief because inflation's come down. We're seeing overall profit margins in the S&P 500, rising. And I would argue that outside of the Mag 7, earnings expectations are quite low. And I think this is why, and we're going to find out next week, 40% of the S&P 500 reports, 4 of the Mag 7 report. But I think this is going to be the best earnings season in 2.5 years. Let's not lose sight of that. Earnings are going to be healthily double-digit, I think.
So, Ben, let's take out tech and let's just look at the consumer names, particularly the story that Lisa just mentioned. demand's okay at the right price. And I think that's what we hear from all of the airlines. I think that's what we see from the automakers as well. They don't have the pricing power anymore. And when that starts to happen, we know what starts to happen with margins and what happens elsewhere. So, Ben, where do you get that confidence around that consumption story when what we're hearing from the companies is that they don't have pricing power anymore?
Yeah, I think this is going to gradually play out. Am I a little bit concerned of the sort of face-ripping rally we've had in small cap and how much we've priced in the last 2 weeks? Yeah, I am a bit, because I do think, this will take a little bit of time, right? The economy will probably keep incrementally slowing, but we need the interest rate cuts to sort of come through. The consumer, the economy will gradually sort of firm up, I think, in the US. What I would also say is there's a big international component to this. The global cycle, I think, is quite different from the US cycle. Europe, EM, has either bottomed or started to recover, and I think that earnings cycle is A, maybe a little bit further ahead, and B, it's a lot more cyclical. So in Europe, for example, this is going to be the end. This quarter will be the end of the earnings recession in Europe, and I think by the end of the year we could be seeing 20 or 30% earnings growth in Europe, just given the cyclicality of earnings. And I think the same goes for parts of EM and potentially parts of small cap.
When we're talking about timeframes, it's actually quite important because a lot of people have come on this show and said, for the remainder of this year, there is some visibility. There's a sense of what different economic policies could be. There's a sense of some of the dynamics heading into November. After that, it gets a lot harder. What gives you conviction that regardless of who wins the U.S. election and some of the policies that result from that, you still could have the environment that you're seeing that could be supportive of smaller companies, even though there are some pretty differing kinds of policy proposals out there?
Yeah, to be clear, I'm not sure small cap will be the first place I would go. As I say, that is the canary in the coal mine. That's giving us a very clear signal of what people are looking at. But, I'm not that bullish to think that, the US economy is just going to turn on a dime here and that's going to take small cap with it. So, I would be looking at financials, I'd be looking at industrials, I'd be looking at Europe, I'd be looking at EM, maybe before I go to small cap. But again, I think, the US economy is in a good place. We are about to get insurance interest rate cuts, from the Fed, which I think will go a long way to giving us maybe incremental visibility on that. And maybe controversially, I think the election is maybe a volatility event and maybe less of a fundamental event. In fiscal policy, for example, I don't see huge differences between the candidates. I think the base case is we end up with a gridlock Congress. I think the risk is we overdo the politics a little bit.
Ben Laidler of Bradesco, offensively bullish. It's good to catch up, sir. Ben, thank you. Appreciate it. Look, one person's rotation is another person's growth scare. That's the last week or so. Bank of America, Michael Hartnett putting it like this. Credit spreads signal the correction's healthy. Then you look at the yield curve and commodities, and they say it's sinister. Got to pick one.
It's very difficult, and the different economies have been moving in different kind of pacing, and that's part of the problem. I like how language matters. For bears, it's profit margins are getting squeezed. For bulls, it's profit margins are getting some relief. It just sort of highlights, how you look at things.
It's a very different way of framing things. Some people enjoying their weekends, other people not so much. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. Uber, Lyft, and DoorDash have won a California lawsuit. The state's top court unanimously ruled that the companies can continue to classify California drivers as independent contractors. The ruling clears what investors had regarded as a major regulatory hurdle. It's also expected to save companies millions of dollars that they otherwise would have had to pay drivers. App-based gig companies have long argued that their drivers aren't considered employees, entitled to minimum wage and overtime protections. Despite the unanimous ruling, further legal and legislative fights are expected ahead. And as the Olympics kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say that people were seen fleeing the sites in vans. Eurostar, for its part, says that its services to London and Brussels have been impacted, with several trains delayed or canceled. The National Rail Company says it will have to repair its network cable by cable. And that's your Bloomberg Brief. John.
Not a great start. That is super sad. Danny, thank you. Danny will be back with us in about 30 minutes' time. Up next on the programme, debating the next debate.
I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. I think the voters deserve to see the split screen that exists in this race on a debate stage.
We'll discuss that split screen up next, live from New York City this morning. Good morning.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Already looking ahead to quite a big week. Next week, this time Friday, we'll be talking about payrolls. 2 days before that, we've got a Federal Reserve decision, and somewhere in between, some of the biggest companies on the planet reporting earnings. Going into all of that, equity futures look like this. We're positive by 0.75% on the S&P 500. A little bit of stability and some calm for once in the bond market. We do nothing. The 10-year, 423.67. Under surveillance this morning, debating the next debate.
So many of you have been asking me about the debate, and I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. He agreed to that previously. Now it appears he's backpedaling, but I'm ready. And I think the voters deserve to see the split screen that exists in this race on a debate stage. And so I'm ready. Let's go.
Here's the latest this morning. Donald Trump's campaign refusing to commit to a debate with Vice President Kamala Harris until she officially becomes the Democratic nominee. A campaign spokesperson saying it would be, quote, inappropriate to schedule things because Democrats very well could still change their minds. Harris responding on social media saying, quote, what happened to any time, any place? Tobin Marcus of Wolfe Research joins us now for more. Tobin, a bit of news this morning already. The elusive endorsement gets delivered by the Obamas to Kamala Harris. There's a bit of a honeymoon period over the last couple of days, Tobin. I'm just wondering from your perspective how much longer that honeymoon period lasts.
Well, I think that depends in large part on how Vice President Harris continues to perform on the campaign trail. Part of the reason why Democrats have been so energized and unified is just the relief at being out from under this Biden catastrophe that they've been living through for the course of the past month. But another part of it is that she's looked pretty good on the trail. You know, the early paid media's look good, a couple good ads up so far, and a string of, solid performances from her. So, she keeps delivering good performances. I think Democrats are very ready to remain enthusiastic. I think there's a sort of palpable eagerness to have something to root for. But, obviously her 2020 campaign did not go flawlessly, to say the least. It's totally possible that we see things start to go a little bit, less uniformly positively. And if so, then I think we'll start to see cracks on the Democratic side.
Tobin, I thought the New York Times Siena poll that just came out yesterday was fascinating, not because it showed that there was more of a tie between Kamala Harris and Donald Trump than we've seen for months with with President Biden, but this part. It said that nearly 90% of voters said they approved of Mr. Biden's decision to exit the race. When have you ever, Tobin, seen 90% of voters agree on something so pivotal as the sitting president stepping down from a race?
Yeah, that's about as high a number as you can get in polls. As someone who has run a lot of polls in my life, you can. It's really hard to come up with something that gets a higher number than 90. So look, I think it just goes to show again how much palpable relief there is at being out from under this. There were differences of opinion, obviously, on the Democratic side about kind of how to handle this, how much pressure to put on Biden. There were certainly some people, including, for example, the Congressional Black Caucus, who were standing with Biden through much of that pressure campaign to try and get him out. But now that he has left, I think there's very, very little second guessing of that. And, again, there are some people who were hoping to have another candidate come out somehow, find some way to run a mini primary, figure out if you can get one of these promising Democratic governors at the top of the ticket instead of in the runner-up slot where they're being considered right now. But that was never really an option. And with all those people immediately bowing out, I think people are now backing the horse that is available to cheer for.
Tobin, there were a lot of people who are scratching their heads at the J.D. Vance pick by former President Trump as the vice presidential pick, given the fact that he hews very closely to Trump when it comes to some of his policies. Within the Democratic Party, how much momentum is there for picking a vice presidential candidate that really is more centrist, even than perhaps Kamala Harris?
Yeah, I think that's what's going to happen. There's questions about which one of the various different vice presidential hopefuls she will end up going with. But, I think common sense and the reporting about who is being vetted all point in the same direction, which is that she's looking for somebody who has some, moderate record and some outside the beltway sort of vibes to them in terms of people to round out the ticket. Again, could be governors, could be Senator Kelly in Arizona, who I think reads a little bit less Washington-y than a senator usually would by virtue of his experience as an astronaut rather than a career politician. But one way or another, I think she is looking in the obvious place for the kind of person she'd want to fill out the ticket.
Tobin, it's been interesting to see the media and Democrats in the last couple of days or so almost try to remodel perceptions of Kamala Harris's role in this administration to separate her from the border by pointing out repeatedly, we might have called her the border czar, but she was never the border czar. This was about root causes. Tobin, I just wonder whether you can pick and choose, whether as the vice president you can say, I was involved in this, I had nothing to do with that. Can you really do that? How much distance will there be between her and the Biden legacy?
So, obviously she's going to face attacks for everything that happened under the Biden administration. Both things in which she had some level of direct role, like, again, this sort of disputed portfolio about what exactly was her responsibility in terms of addressing the root causes of immigration. But even more broadly, things that happened that she had nothing to do with, she will continue to face criticism for. I have no reason to think that the Trump administration, for example, is going to stop criticizing the withdrawal from Afghanistan and kind of pinning that on her as a member of the Biden-Harris administration, even though nobody believes that she was the decision maker on that. That being said, it does seem to be the case in some of the early polling from Democratic pollsters that there is less baggage with her than there was with Biden. On inflation, for example, which obviously had been one of the persistent vulnerabilities for President Biden, in addition to his age, looks to be the case that there's a little bit less association of the retrospective bitterness in the run-up in price levels, distinct from the current run rate of immigration for Harris rather than Biden. And again, a lot of it comes down to her. How effectively can she pivot away from some of these attacks, both on the Biden record and on her past positions, where obviously Republicans are already, kind of criticizing her for all the position taking that she did in 2019 and 2020 around banning fracking, around decriminalizing border crossings. These various different things that she kind of signed on to during that primary when a lot of Democrats were racing to see who could get farthest left. But again, flip-flopping is a thing that happens in politics. If she can give a compelling account of where she stands now and what she wants to do going forward, I think it does, mitigate some of the vulnerability from things she said in the past.
They are the ultimate shapeshifters. I expect no different from either side. Tobin, thank you, sir. Tobin Marcus there of Wolfe Research. I keep going back to what Libby Cantrell said just yesterday. Ignore the polls. Wait until September. Got to wait for the DNC, see who the VP pick is. Let all this bed in. Just wait a while. And then we'll get a better gauge of where things stand in this country.
That's the reason why I thought that just the approval of where we are right now was sort of shocking. The polls maybe not so much because those are going to change quite a bit. But the fact that everyone did not want the race that we were having, and they're so happy and relieved. You wonder how low the bar was for anyone to come in who is under the age of, say, 70 to really re-galvanize this race.
The double haters is a big, big deal in all the polls over the last year or so. Coming up next on this programme, the yen rally at risk of breaking as investors await rate decisions from the Fed and the BOJ. That's next. This is Bloomberg. Live from New York. Welcome to the program. Here's the state of play for you. Positive by 0.75% on the S&P 500, bouncing back by almost 1% on the Nasdaq 100, and once again, massive outperformance on the Russell 2000. Small caps up by 1.65%. As of yesterday at the close, still poised for a third week of losses on the S&P and poised for a third week of gains on the small caps. In the bond market, your yield curve looks like this: the 2-year, 10-year, 30-year doing nothing. We can take a break for once. The 2-year down to about 442.45. There was just a feeling that the data yesterday gave us a real break, that we could go into the Federal Reserve on Wednesday next week without this urgency that they need to cut interest rates because the labour market is breaking. I just wonder whether Friday's payrolls number endorses that view.
At a certain point, it seems like people are rallying around the idea that these can be insurance cuts or preventative cuts of something that is more pernicious. And yesterday's prints really seemed to highlight that that seemed to be the case. Question is just how much the Fed commits itself. And to Bill Dudley's point, what we're not seeing, because there have been a lot of downward revisions in the labour market data, and that, I think, is one thing a lot of people are pointing to.
I think this comes down to two things, Lisa. I think it's one, what is your assessment of the labour market? And two, what do you infer from that as to how much time you think you have to remain on hold at the Federal Reserve? And when we spoke to Bill Dudley yesterday, his view on one was that this labour market is more fragile than the Fed thinks, and two, they have less time than maybe they think they do. And this is what's interesting about next Friday for me. How does this market respond if we get a bad payrolls number? How does this market respond if we get unemployment going through the so-called SARM rule? Is the Federal Reserve comfortable with all of that? They might just say it's a one-off. Based on some of the commentary we've had over the last couple of days, I can imagine people piling on and saying, this is it. They've got to make a move. It's growth scare. The labour market's breaking. We're heading to recession. The SARM rule's triggered. Then you've got an even messier market. And we're this close to something like that happening.
You frame this as, how will the Fed respond to this? There's also this question of, how does the market respond to this? And we've kind of gotten a sneak peek at just the surface of how that response, how deep that response could potentially be. What we're looking at in markets is the hope and the prayer that the Fed cuts rates proactively. If they cut reactively, we've gotten a sneak peek of just how much we could see that sell-off. And Michael Hartnett of Bank of America saying, actually, even financials are set to lead downward if we do get a true growth scare and do see some of these revisions continuing, particularly on the negative side in the labour market.
Michael's point, he says we're one bad payrolls report away from all of that. Let's see if that payrolls report comes on Friday. The trend over the last 2 years has been to surprise to the upside. So let's see. Let's turn to foreign exchange. I want to talk about dollar yen. The range on dollar yen in yesterday's session, OK? At the low of the session, 151.94. At the high of the session, 154.32. And at the close, just short of 154. Right now, we're back to 154.30. We had saw massive swings on stocks like Nvidia, but we also saw big swings cross-asset in currency pairs like dollar yen in yesterday's session. I think as things stand still, we're still heading towards a fourth weekly decline on that currency pair. Haven't seen that all year. Going into quite a big week also for the Japanese next week.
Yeah, for the Bank of Japan to come out and decide whether or not they're going to hike rates. In a lot of the research notes that I've been reading over the past couple of days, the ultimate question is, how vulnerable is this market to an inactive Bank of Japan meeting? If they do not raise rates next week, how much does this yen weaken right back to where it was before this rally began? It feels technical in nature, unclear what's driving it. The Bank of Japan could quash that if they want to by simply doing nothing.
Dollar yen, 154.30. Under surveillance this morning, our top stories. Let's start with this one. Vice President Kamala Harris pushing Israeli Prime Minister Benjamin Netanyahu to accept a ceasefire deal with Hamas, highlighting concerns over the civilian death toll in Gaza. Netanyahu also met with President Biden and will be visiting Donald Trump at Mar-a-Lago later on today. So picture this, you're a foreign leader and you've now got to meet with three. Got to meet with the sitting president, separately from the vice president, and also you've got to meet with the former president who might be the next president as well. What on earth does policy look like after January?
Well, this is part of the reason why Peter Scheer is very concerned about some sort of geopolitical issue springing up now, because it feels a little bit, not that there's a vacuum of leadership, but that it's unclear who has the strongest grip over policy going forward. And I'm talking about beyond January of next year. It's interesting to see how Kamala Harris was trying to create daylight between her policy and Biden's policy, coming out with some harsher words for Netanyahu. And then, of course, you have Donald Trump, who is a huge supporter of Bibi Netanyahu. And this sort of acceleration of the divergence in U.S. politics by Netanyahu is something potentially some people have speculated he could exploit.
He's in a hot war. You've got Ukraine in a hot war. And they could have a very different relationship with the United States of America come January, depending on who wins in November. That's quite a turn of events. The lack of continuity in foreign policy in America, I think, is what Peter Cheer is getting at over at Academy.
And it starts to sort of raise the question of what could happen. You start talking about Ukraine, and Volodymyr Zelensky really said, look, I know you don't want to talk about things publicly, but just let us know. If you're going to be playing with our future, I just want to know what the policies are from the prospective nominees, because a lot could change and we want to be prepared.
That's the latest in Washington. Let's get to the latest in China. Apple losing ground. How many times have we seen reports like this? Market tracker IDC saying iPhone shipments dropped around 3% in the last quarter, pushing Apple out of the top 5 as local rivals such as Huawei have been surging ahead. Even deep discounts. And I think this is the important point here, failing to help boost sales of Apple at a time when the sell side leads are getting bulled up on this idea that when the new iPhone drops in September, you're going to get this massive upgrade cycle off the back of it.
So here's what I'm looking for. How many international companies are going to start to X out China and propose growth models that have nothing to do with that nation? Because essentially there have been a number of reports that a number of the executives who went to China from the United States, big heads of multinational companies, don't know how welcome they are. And the rhetoric is not convincing because policy has not been. With Apple, sure, you could say that the price is probably part of the issue. You could say also that, hey, the phones have been banned by a lot of governmental agencies. There's a big push into national companies, which have exceeded, all of them have exceeded Apple for the first time. It just creates a very difficult environment to really have any predictability. We're talking about U.S. policy uncertainty. Sure. How about China policy uncertainty for some of these companies?
Look, that environment is always going to be cultivated by the central government, by the Chinese Communist Party, but also this turn of consumption, how consumers have gravitated towards national players. You mentioned Peter Cheer. That's also something Peter Cheer has been on top of. How welcome are they? Not just by the government, but also by the consumers on the mainland.
Which, again, goes to this point of how much are companies still expanding in China? You know, whenever we ask people about China, executives of companies, they always really hedge, almost invariably. Qualcomm CEO is a little bit different. He said, we like China. It's important for our business. But most executives say, you know, we're cognizant of some of the risks. It's an important market. We are aware. We want to make sure that we're, you know, being within everybody's guidelines. What they're doing is totally different. They're moving production to India. They're moving away. They're diversifying their supply chains. They're very aware of the potential risks.
It's not what they say. It's the physical reaction that gets me. You know, the jacket will be done up, and then they'll undo the button because it's getting a bit hot. Yeah. And then they don't know what to do with their hands anymore. So they're sort of like this, trying to, yeah, no. It's the physical reaction. You just saw them, they react physically to it. They know it's a topic they've been briefed on by public relations just not to touch. Don't go there. Don't go there.
Nothing good can come of it on either side of the equation.
We keep asking. Apple's positive in the pre-market, we're up by about 0.9%. It's a difficult one for them, I know. I want to turn to foreign exchange. Investors looking ahead to a double dose of central bank rate decisions in the next week. The Fed and BOJ both drop on Wednesday. The yen rally facing a moment of truth as the currency holds onto an advance of about 5% against the dollar since just before it began surging on July 11th. Jeremy Stretch of CIBC writing this: should the bank desist from tightening next week, as we assume, we would be mindful of dollar yen retracing half of the recent correction. Hence, we are mindful of a correction back towards 156.90. Jeremy joins us now for more. Jeremy, we've seen massive swings in dollar yen over the last couple of days. What do you think has been going on? Is this all just about fundamentals and looking ahead to the prospect of a rate hike next week, or is it something more than that?
Well, I think there are a couple of things definitely in play in the context of this move. Clearly, we've seen excess yen short positions. Some of those have now been partly compromised. But I think also at the same time, we've seen increasing speculation of late regarding the prospects of a BOJ hike coming at next week's meeting. So in the context of yesterday's move, when we did trade briefly below 152, we were trading in the region of 9 bips or so higher, or around that sort of threshold in terms of pricing for next week. So amplification in terms of BOJ assumptions, allied to paring back in yen short positions, have really amplified this sort of uncertainty and volatility, which, of course, comes as we've seen risks very much under threat in recent sessions. So I think there's certainly a couple of factors in play, but I think in terms of the BOJ, we would expect once again the bank to overpromise and underdeliver or maintain a dovish tone, and that is why we would probably prefer to anticipate that dollar yen does risk moving back higher.
Jeremy, you said there were a couple of factors at play. How much is a sort of fundamental question about the Bank of Japan, and how much is this just a couple of hedge funds that blew up?
Well, I think, as I say, we have seen significant repricing, or at least attempts to reprice the BOJ view for next week. So I think that's one of the factors. But clearly, I think there is a case to be made that when we do see episodes of market uncertainty, then it is often the case that some of those positions which are proving to be profitable are also unwound as a consequence of any uncertainties elsewhere in the market. So I think there are a combination. I wouldn't necessarily ascribe a particular sort of proportion or dynamic influence on either of those factors, but I think the combination have certainly proved to be a fairly powerful cocktail in the context of what are, of course, relatively illiquid in summer markets, and that does amplify that intraday volatility.
Jeremy, how much is this a yen story, and how much ultimately is this a dollar story? Is this a question about people getting more confident that the Fed's going to hike cut rates at least in September in the face of data that's definitely cooling?
Well, undoubtedly, in our view, we have been anticipating a September Fed rate cut for some time, and we would and had been expecting the data to validate that. And I think that generally is broadly proven to be the case. Now, obviously, that GDP print yesterday was somewhat hotter than expected, but I think the underlying trend is of a slower pace of growth, certainly in the first half of the year relative to last. And I think the inflationary dynamics, as well as the labour market, are also signalling that there is a need or a necessity for the Fed to start policy easing come the September meeting. So I think there is increasing confidence in that regard. And I think it may be the case that whilst we continue to see US economic exceptionalism relative to the rest of the world in the first half of the year, I think that exceptionalism and the argument around that will start to dissipate as we move forward. And I think that does validate the presumption that the impetus of the dollar, I think, will gradually reduce, albeit, of course, there are still cross currents, not least of which in relation to US political dynamics.
Jeremy Stretcher, CIBC, looking for a swing in the other direction. Jeremy, appreciate it. Looking ahead to the BOJ and the Federal Reserve next week. I think Lisa took this conversation in the right direction. When you have a big consensus trade like this one, short Japanese yen, for this long, other things are kind of built on top of it. So when you snap back the other way with speed, and it's the speed that matters from, say, 160 down to 150, things start to crack elsewhere. Identifying where those cracks are and where they're coming from is important.
Yeah, and I don't want to spread rumors saying that someone blew up, because there's no evidence to suggest that. It's just simply, there seems like perhaps there were a few, trades that sounded and rhymed very similar that were leveraged that got blown out at the same time. And we saw the unwind of that. And that's what a lot of people have been talking about. Very hard to attribute some sort of fundamental reason behind that.
Dollar yen has had a 157 handle this week and a 151 handle this week as well. That's quite a range. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mercedes is the latest automaker reporting a decline in its second quarter profit. It trimmed the upper range of its forecast. It now expects returns on sales between 10 and 11%. It previously said the high end could be 12%. Automakers are under pressure from weaker demand in China and a drop in purchases of battery-powered cars in Europe, with governments cutting back on financial incentives. Mercedes shares fell as much as 3% in the early trade before paring some of those losses, given weak earnings were somewhat expected. Shares are flat over the past year. And JP Morgan has launched a new internal AI chatbot in one of Wall Street's largest use cases for the technology. In a memo viewed by Bloomberg, JP Morgan told its employees to use its own version of ChatGPT as a writer, idea generator, and problem solver. The FT earlier reporting that the chatbot could do the work of a research analyst. Many of the big banks have been experimenting with AI over the last year, with hopes it lives up to its productivity and cost-cutting potential. Citigroup has estimated that the technology could displace more jobs in banking than any other industry. And former First Lady Melania Trump is publishing a memoir this fall. The self-titled book is described by her office as a, quote, powerful and inspiring story of a woman who has carved her own path Overcome Adversity, and Defined Personal Excellence. The book will sell for $40. A signed copy will be available for $75, and the collector's edition will go for $150. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that's something that the next administration is going to have to address.
Up next on the program, the former World Bank president, David Malpass from New York. This is Bloomberg. If you are just tuning in, welcome to the program. Equity futures bouncing back. Pretty volatile session yesterday, and I have to say, pretty volatile week. Equity futures up by 0.75% on the S&P. In the bond market, yields just about unchanged. The 10-year 4.24. Under surveillance this morning, big policy questions on the horizon.
The trajectory for debt and deficits is quite dire, regardless of who gets elected. I think that's something that the next administration is going to have to address. It makes it very tricky for the Fed to be able to cut rates, in an environment where debt and deficits and long end yields could potentially rise if the market and the bond vigilantes start to kind of push back on the narrative that's coming put forth by the administrations that come to power.
So big week ahead, and here's the latest this morning. Treasury's holding steady after recent gains as optimism grows over the Fed's first rate cut. Bond traders also looking ahead to next week's quarterly refunding announcement from the Treasury Department. Alongside us in the studio here in New York, the former World Bank president, David Malpass. David, good morning to you, sir.
Good morning, John.
I want to start with this quote, and I think this is a timely conversation for us. It comes from Hudson Bay Capital, Stephen Mirren, Nouria Rabini, two people I'm sure you know well. Here's the quote. By adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them the economy, essentially taking over the core functions of the Federal Reserve. And they dub this novel tool activist Treasury issuance, or ATI. Can we just reflect on all of this? What did you make of this piece? What are they telling us?
I love new acronyms, ATI. So activism. So Treasury has to decide every quarter whether to issue T-bills or bonds and which bonds to issue. And they do that in conjunction with Wall Street. And the problem, and I've written a lot about this in the Wall Street Journal, is that puts an overlap between them and the Federal Reserve. So that's a challenge right there. As you decide where the issuance is going, it affects the shape of the yield curve, and when you do that, you're affecting stock prices. So you've got this giant direction for capital based on whether Treasury is borrowing short or long. Right now, for years now, they've been borrowing too much at the short end and not enough in the 10-year kind of window, the 30-year window.
And why does that deliver meaningful consequences? Can we explore that a little bit more? If you think about the shape of the yield curve, it's the same amount of debt. It's just being issued at the front end of the yield curve and less at the long end. Why are there meaningful consequences when you increase or decrease the level of debt at the longer end of the curve?
When QE started, that was the Federal Reserve buying a lot of bonds in, say, 2010, 11, 12, 13. That flattened the yield curve. So you had the Fed buying longer maturities, basically the Fed buying duration. So when the market hears that, that's positive for equities, but it's not positive for small businesses around the country. They borrow at the short end. So basically, Treasury is the big foot coming in and borrowing right at the spot where your small businesses want to borrow for inventory, for construction loans. So if you could change the shape of the yield curve to be more upsloped or upsloped at all right now, you would liberate a lot of floating rate loans for people that really need them day by day in order to get their businesses growing.
Some people could say that this is actually just smart policy because ultimately the Treasury Department didn't want to lock in borrowing costs at 5% for the next 10 years. And they wanted to have a short-term kind of lease on rates that were at the highest levels in decades. Why don't you see it that way?
Hi, Lisa. I think that's a bet made by the Treasury. So we already saw a giant bet made by the Fed on duration, and they've lost, billions and billions. And I think it will end up being $1 trillion from that mistake when they were buying long bonds with short-term interest rates. Think Silicon Valley Bank, or think a hedge fund that made a bad bet. So as Treasury does that, they should be more neutral about the economy. Here we are coming into an election cycle, and they have they're holding down the long end of the curve, which props up the equity market. It fuels, think of where the capital is going right now. Treasury is borrowing short, so it means a lot of long-term, long-duration capital can go into equities or can go into long-term bonds. So you have this phenomenon for years now of corporations issuing bonds and buying back their stocks. You've got dividend recapitalizations going on now. This is all a phenomenon of the shape of the yield curve, which is being controlled, I think, in an anti-growth way by Treasury and the Fed.
This may sound like an esoteric conversation. It's pretty much anything but. It's talking ahead of 8:30 a.m. on Wednesday, when we're going to get the Treasury refunding agreement, where they announce what kind of maturities and the amounts that they're going to be selling of government debt. It comes at a time where Fitch said in a recent report that heavy Treasury supply is a key risk to our lower yields call across the curve. And it comes at a time when you potentially are rumored to have an ear toward another administration of Donald Trump. What would you, if you were in a situation to dictate maturities, do in order to, say, increase maturities of U.S. government debt while not sort of causing this massive sell-off at the long end that could be hugely disruptive?
Yeah, and I think you have to be neutral from Treasury and from Fed, that you're not trying to manipulate the yield curve. Historically, there was remember the Operation Twist, which was a big failure in a previous decade, a previous century. And so the government has tried to do this, and it ends up hurting people within the country. So all you have to do, I don't think it's that hard, is say what your goals are, that you're trying to not have the short-term funding be the most efficient. The Treasury is making a bet right now that they'll be able to refund at a lower yield later on. How do they know that? And wouldn't it be more confidence-inspiring if they allowed the market to help them do that? They're asking the world to keep giving, the U.S. borrowed, the Treasury borrowed in 2023, $23 trillion in its coincidence in 2023. And so that's a giant amount of debt for the market to digest. So say to the market, we are working toward a lower yield curve that's upsloped, that's going to maximize business confidence and be very positive for growth. They're not doing that. They're saying instead, we're going to keep borrowing short term because, as Lisa's pointing out, it might be cheaper if yields fall. It might cost them a lot. Right now, it hasn't been a good bet. If you look back
the core principle,
over the last
as you know,
2 years,
David, just to jump in, is meant to be regular and predictable debt issuance out of the Treasury. That's meant to be the core principle. Do you think we've moved away from that? Do you think this is a permanent fixture of policy now, this tool?
Clearly, it depends on the political cycle where you're going to borrow on the yield curve, and if you're trying to prop up markets in the short term or the long term. And that also affects, and it's very important, the actual capital flows going on in the economy. So there's been this heavy bias toward big companies and toward the government. So, that same point that you're making about where the Treasury is issuing means that the government feels comfortable with this giant fiscal debt because you're not borrowing at the long end of the curve. I think we need to go to a more neutral, balanced environment with a more independent Fed that's not really facilitating this process through its own. Is it coincidence that the Fed moved to QT to phasing out QT right now in this part of the curve? They should be allowing that long bond portfolio to run off. That would be confidence inspiring for markets.
David, it's good to catch up with you, sir. I feel like we've only scratched the surface and we need to go a lot deeper on this topic. Thanks for giving us your insight. David Malpass, the former World Bank president, on a key issue. That note and that research from Nouriel and Stephen, it has had so much attention over the last week or so.
If you extrapolate it out, There's a real question, what is the consequence of higher long-term yields if you do allow them to be determined by market prices? And there was sort of this implication, maybe U.S. government officials would take the deficit more seriously if the market were determining levels. Maybe it would be more of a gut check that would actually push people to a bit more action on the policy side.
Well said.
Thanks.
Well said. Coming up next, got David sort of nodding his head as Lisa's talking as well.
Well said.
Well said. Coming up next, Victoria Fernandez of Crossmark, Sucharita Kodali of Forrester Research. We'll catch up with Giorgio Furlani, the AC Milan CEO, and Sheila Kahyaoglu of Jefferies. All of that and more in the second hour of Bloomberg Surveillance.
The Fed doesn't want to appear panicked, particularly when the underlying breadth of data do not suggest the broader economy is falling out of bed.
We're getting a little bit too carried away with negative surprises where, in fact, we are still seeing broadly stable data.
If the labor market starts to show signs of weakness, we have to go faster.
The data right now does seem consistent with an adjustment cutting cycle. You're seeing that gradual cooling.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, and it begins with a snapshot of your equity market. And this equity market has been all over the place over the last week. Monday was the best day of gains since June. Almost forgotten about that, haven't we? It was a nice bounce back a little bit earlier this week. And then Wednesday happened, which was like the worst day of losses so far this year. And then we added to it yesterday, even though literally 15 minutes before the close yesterday, it felt like we might finish in positive territory. Lisa, all over the place is the right way of describing this equity market.
And part of the reason why is because there just isn't necessarily a clear compass. The economic data has had ups, has had downs, hasn't necessarily been particularly consistent. And frankly, neither have corporate earnings. I mean, yesterday we were talking about Ford having its worst day going back to 2008. We're talking about American Airlines slashing their full year forecast. Today we get 3M boosting profit forecast, Colgate raising its full year organic growth models, Bristol Myers beating. It is an inconsistent and difficult picture to really wrap your head around.
People always use that word, don't they? And it frustrates us both. Idiosyncratic. Stellantis, idiosyncratic, because obviously there's this EV thing going on at the moment and they're at the wrong time, at the wrong place and all of that. Then you look at another company and you can make another excuse. Kering, well, they've got Gucci. Gucci can't execute. And I think that's the difference for me. What is it about execution? And what is it about the US consumer right now? Where's the real struggle? Are people just not executing, or are they just struggling because the consumer's weakening?
It's a great question. And to me, the answer really lies in what does it mean to execute? Is it just simply the right types of strategies, or is it the most cost-efficient strategy? Are we talking about cost cutting? You know, Bristol Myers talked about that. McDonald's just talked about how the $5 meal is bringing more people back into the fold, and they extended that because people are much more cost conscious. When you start talking about efficiency, cost cutting, you start thinking about job cuts and other things like that. How deep does that go? And that really ultimately, I mean, people are getting sick of this, but it goes back to weakening or weak. We just aren't sure, but right now people are still coalescing around weakening, and it's healthy and planned.
Well, it's certainly weakening, without a doubt. Let's just pick out two names. Two of the biggest food and beverage manufacturers on the planet. Pepsi, Nestle. Pepsi, in the US, there is clearly a consumer that is more challenged. Nestle, there is value-seeking behavior among consumers. You can't avoid this. You can't call that idiosyncratic. That's a consumer pushing back, and that's a company losing pricing power, and we've seen that repeatedly.
Take Nestle, cocoa and coffee, right? That basically cocoa beans and coffee beans, both of them have gotten more expensive. This is commodity prices increasing on their input costs, so they cannot pass it along to consumers. Cameron Dawson was talking about this yesterday, that you start to see margin compression, or margin relief, as Ben Laidler would call it, at a time when inflation is coming down, that it might be good for the consumer, but it tends to be bad for corporate profit margins. Is this a company-specific problem and not necessarily an economic problem? No one's really able to get their head around that right now.
When there's enough companies having the same problem, you've got an economic issue, right? Because they're cutting costs.
And they're cutting jobs. And that is clearly what we're seeing. And the backward-looking revisions of what people are watching. How much do we not understand the real-time data, because it's going to get changed so much when we take a look at what it really was a couple months later?
You just get the feeling from a market perspective, things are so finely balanced, you're like one bad data point away from this all changing. Michael Hart of Bank of America basically said the same thing. One bad payrolls report away from changing this whole story for some of the biggest companies on the planet.
I also think a lot of people aren't really necessarily conditioned for this type of environment. We've seen huge swings, right? We saw the 2008 crash. We saw the pandemic. Everything kind of went at once. And this has been a story of many different industries that are moving at their own paces. We see services side inflation coming down. We see goods inflation coming back up, actually already having seen that trough. And all of a sudden starting to get more expensive because cocoa beans are getting more expensive, because some of these companies are saying, well, maybe we need to cater to a higher end consumer in order to be more profitable.
We can talk about the airlines later, but I was thinking about American trying to pivot, Southwest trying to pivot, at a time when maybe the high-end consumer now is starting to push back as well, based on what we've heard ex-Hermes in the luxury state of play.
Assigned seats in Southwest.
I know, it's a big change.
Have you ever actually flown Southwest?
I haven't, but I've done Ryanair.
Okay, it's basically the same thing.
Okay. You know, sort of like when Ryanair peaked, late 90s, when you sort of run across, you know, early 2000s, you'd run across the tarmac to try and get a seat and elbows
Would
out.
you?
Yeah, oh yeah, then you'd have to like try and save some for the family to make sure no one else sat beside you.
Did you ever elbow someone out of the way and then have to sit next
I
to the
would
person
never
you
get
elbowed
physical,
out?
Bramo.
Okay.
I would never do that.
Can you imagine?
No, that would be pretty
That'd be
awkward.
really
But I'm
awkward.
sure that happened. You know,
all the
back
time.
in the day, Ryanair was pretty brutal. I'm happy that Michael O'Leary changed things because that wasn't a nice experience. Equity futures right now on the S&P 500 look like this. We're positive by 0.7%. In the bond market, yields 4.24 on a US 10-year. The euro just about unchanged, 108.54. I want to sit in the commodity market just for a beat. 77.92, down about 0.5% in crude. And I mentioned Michael Hartnett of Bank of America a little bit earlier. Look, one person's sell-off and growth scare is another person's rotation and broadening out. And I think it's really important to sort of separate those two camps right now. And you can give each camp some fuel. And this is what Michael Hart is talking about. You can look at one and say, look, credit spreads are okay. They're still pretty tight. The economy's fine, and so's this market. This is just a broadening out. But when you look at commodities and look at what's happening with the yield curve, particularly the rally at the front end of the curve, you can make the argument that a growth scare is starting to emerge.
Take a look at copper prices. I mean, aside from just sort of the yield curve, the forward contracts, near term versus long term, take a look at how much copper prices have come down. Why? Is that because of some sort of normalization after an incredible boom, or are people starting to sniff out that maybe that commodity boom, that building infrastructure kind of development isn't happening as quickly as they previously thought?
We'll get some thoughts on commodities for you in just a moment. Here's the state of play for this hour. The next 55 minutes or so, we'll catch up with Victoria Fernandez of Crossmark on the great rotation, Sucharita Kodali of Forrester as the US consumer pulls back, and Sheila Kahyaoglu of Jefferies on volatility in the airline industry. We'll begin with our top story, the S&P 500 notching losses for the 6th time in 7 sessions as the rotation trade continues. Victoria Fernandez of Crossmark writing this: we are invested in the market, but with a weakening labour market, higher credit card and auto delinquencies and seasonality shifts, we could see a softer second half of the year. Victoria joins us now for more. Victoria, I want to start with the consumer. Lisa and I spent some time talking about that. There's a few companies out there saying things are weakening. Others say things are okay. What are you focused on?
Yeah, well, Jonathan, I think this is the problem that we're seeing. We don't have a consistent message coming from the earnings season telling us one way or the other so that the market can make a definitive decision on where it wants to go forward. That's what's causing some of this volatility that we're seeing in the market, especially like yesterday, up all day and then down at the end. So in our eyes, it all comes down to the labor market. You and Lisa were talking about this earlier. The labor market is key for us, and not necessarily the payrolls number. I'm looking more at the JOLTS number. I want to see those job openings. I want to see how long it's taking someone to find a job once they leave somewhere. Temporary work, we know that is a precursor to what we're going to see in the labor market as a whole. I think that U3, U6 number has kind of muddied the waters a little bit with the immigration issue. So I think focus on JOLTS, get an idea of that labor market, because it flows through to everything else we're seeing. It flows through to wages. Then you have the consumer pull back, and we know the consumer is driving this economy. You get consumers pulling back, revenues pull back, margin compression, layoffs go up. It is a cycle. I talked about this with clients in Kansas City yesterday. Follow that cycle, and it tells us things are going to slow down in the second half, and we need to be ready for that.
So, Victoria, here's the question I would have for someone like you who likes financials. Why on earth would I want to own the banks going into what you've just described?
Yeah, I think we have to look at it from a technical side as well as a fundamental side. I know, Jonathan, you asked me a couple months ago, why are we sticking with financials? And look at the run-up that we have seen. It comes down to the fact that when you're going to have volatility in a market, we had the VIX up to 18, up 20% this week. You need to have companies that have strong balance sheets, good cash flows. They can handle this storm. If we're getting a re-steepening of the yield curve, which we typically get before we go into a recession or a pullback, I hate to use the word recession anymore, but as we go into a pullback, that actually will be beneficial for some of these financial companies. But we're talking the larger banks. We know Russell 2000 has done better because of some of the regional banks, but we would say stick with these larger banks with the good balance sheets. They still have people using their credit cards and paying those off. Even though delinquencies have risen, consumers are going to rely on those credit cards as well. So I think you have a couple reasons as to why in a market where a lot of elements are going down, financials still have over half of their securities in that sector over their 50-day moving average.
Victoria, you talk about diversification across sectors and across asset classes and how important that is. What does it mean to be diversified right now at a time when we've seen sort of odd correlations and a lot of the traditional sort of 60-40 aspects of portfolios haven't been reliable?
No, you're right, Lisa. And we were actually just looking at correlations in consumer discretionary this past week and how that has really fallen out of bed. You really have to be specific when you're going in and looking at names, really doing that homework, looking under the hood on the fundamentals. But for us, diversification doesn't just mean within the equity sector. You know, we've been talking about financials. We've been talking about healthcare. We've been talking about some of the staple names that have pulled back in the first part of the year as areas to go into. But we also think you need to put some money to work in that fixed income world, lock in some of those higher rates, at least for the next 18 months to 2 years, to help buffer some of the volatility in the equity market. But look, there's other elements. Generate some income in your portfolio with call options. That's one of the most liked strategies that we have at Crossmark, where we're seeing a lot of flows come in. But you can also have allocations to things like absolute return strategies. So there's a lot of elements where you can go in, build your portfolio out to really kind of buffer some of this volatility. It's not just within the equity sector.
Next week's massive. I know you know this. We've got the big tech earnings from Microsoft, Apple, Amazon, and Meta. We have, of course, the payrolls report on Friday. And then on Wednesday, the Fed meeting, as well as the Treasury financing or funding agreement, which actually could be important for duration.
Absolutely.
What do you think is going to be the biggest market moving event among those?
Yeah, I think it's really hard to pick from those. But I will tell you, I'm actually going to be watching the quarterly refunding announcement. When we look earlier this year, some of the biggest spikes that we've seen in yields have come on the quarterly refunding. Obviously, the deficit is a huge issue, and people are very concerned about what's happening there. And that gives us a clue into what our interest expense is going to look like, and issuance going forward could lead to downgrades for us from some of the rating agencies. So to me, that is extremely important. We know that some of these tech names, valuations are coming down a little bit. So I don't think we'd be completely surprised if we see earnings just hit expectations, maybe not go further and guidance come down. I think we know the Fed is using this meeting as a setup for September. So to me, actually that quarterly refunding, I think, could be key.
Victoria, do you share this view that the Treasury is deliberately manipulating the shape of the yield curve by issuing more at the front end of the curve?
Yeah, I was listening to your conversation with David Malpass, and I'm not sure if they're trying to deliberately change the shape of the yield curve, but I do think they're trying to go in and figure out a way to reduce interest expense going forward. If they can issue more T-bills in doing that, which we've seen in previous refunding announcements, then I think that benefits them. So I'm not sure if it's an intentional yield curve movement. I do think it's intentional to try to reduce interest expense, again, leading to the idea that we could get downgraded if that continues to go higher.
Victoria, appreciate your view going into next week. Victoria Fernandez at Crossmark. Lisa went through a range of stories to look ahead to next week, including payrolls. Payrolls, the estimate in our survey. Sneak peek for you, Lisa. 175 is the median estimate in our survey so far.
How low is the bar for the market to change its narrative, or how high? I mean, this is sort of going to be the key question. It's not just the actual number. I still think that the revisions are becoming increasingly important as they pretty consistently downgrade the view from the month before.
Household versus establishment, still playing that game. Unemployment, by the way, the estimate in our survey, we're looking for that to stay at 4.1%. Let's give an update on stories elsewhere this morning with your Bloomberg brief. We can cross over to Danny Berger. Hey, Danny.
Hey, John. The world's biggest eyewear maker, EssilorLuxottica, says Meta is planning to buy a stake. The investment would see Meta push into virtual and augmented reality for smart glasses after years of the two companies working together. Luxottica's CEO made the comments late Thursday after weeks of speculation about the U.S. tech giant's plans. He added that if Meta decides to invest, it would have to buy shares on the market, declining to elaborate on the size or timing of that stake. And a top candidate to succeed Boeing CEO Dave Calhoun at the end of the year has emerged. Stephanie Pope, who runs Boeing's commercial airline unit, made the rounds at Farnborough International Air Show as the plane maker's highest-ranking official in attendance. Pope was promoted to chief operating officer late last year, making her the heir apparent, and Calhoun has publicly endorsed her as his natural successor. Vice President Kamala Harris has officially joined TikTok. Since she began her presidential campaign 4 days ago, TikTok and other social media platforms have seen a groundswell of viral memes, images, and videos featuring the presumptive Democratic presidential nominee. More than 95% of left-leaning TikTok posts about Harris currently have a positive sentiment towards her, according to Credito IQ, a social media analytics firm. Harris has more than 1.3 million followers. Former President Donald Trump, who has been on TikTok since June, has 9.2 million followers. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Nobody's dealing with that platform anytime soon. Just on fundraising, love this story. We'll touch on it more a little bit later, but I want to give you some numbers. So there is a cryptocurrency industry event taking place in Nashville tomorrow. There will be a private fundraising effort for Donald Trump, including asking prices. Get ready for this. If you live outside of America and you're not familiar with the fundraising efforts, this will blow your mind. The asking price of $844,600 for a seat at a round table. If you want the opportunity for a photo with the presidential candidate, $60,000 per person. And Lisa, if you want for $100,000 per couple. So if you want a photo for two people, you and your other half, $100,000.
Some people would say, why would anyone do this? And then we hear about how Elon Musk and some of his decisions to donate to Donald Trump would actually put him in a better position should Donald Trump be president, even if his policies seem like they are against his business. There is this sense that the more you have some familiarity with the potential future president, the better for you.
According to an invitation to the event, if you've got that kind of money, it's like $1 Bitcoin apparently in our story, $1 Bitcoin for a photo with the former president. Up next, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. So I think it's a slowdown story versus a recessionary consumer spending print.
That conversation up next. Live from New York City this morning. Good morning.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Counting you down to the opening bell, attempting to get you to the weekend. Equity futures look like this. About 2 hours away from that open. We're up by 0.75% on the S&P 500. In the bond market, yields just about unchanged. The 10-year not doing much. 423.67. A bit of quiet. A welcome bit of quiet, I have to say. Under surveillance this morning, the consumer pulling back.
There's a weakening in the U.S. consumer. Consumers are spending, right? But they're not spending as much as they used to. If you look at credit card spending data, for example, if it was up 7 or 8% year over year, now it's maybe 3 to 5%, depending on what kind of a consumer you look at. So I think it's a slowdown story versus a recessionary consumer spending print.
Things are cooling. They're not cool. How many different versions have we heard of that over the last couple of weeks? That was from Michael Gapin at Bank of America. Here's the latest: consumers pulling back from post-pandemic revenge spending, and it's starting to hit the top and bottom lines of companies, from food producers to airlines and luxury retailers. Sucharita Kodali of Forrester writing this: many consumer-facing retailers, Nike, Target and others, aren't doing particularly well. I don't know that that is economy related, but rather execution related. Sucharita joins us now for more. Sucharita, that is a really important distinction. And we asked this at the top of the programme. There's an execution issue, then there's a consumption issue. Which one is which right now for many of these companies?
Well, in the case of some companies, like Nike's a good example, where the category may be doing okay. Their competitor, for instance, at this point in time, Adidas, seems to be having more traction. That suggests that the consumer isn't necessarily pulling back from the category altogether, or the subcategory in their case, and that issue is more related to perhaps their product assortment and some of their innovation levels. Now, from an overall consumption level, what we are seeing is that the numbers are softer than they were during the pandemic. But we have to also keep in mind that the pandemic, the economy experienced some of the highest levels of spending that we had ever seen. And that was even inflation adjusted. And then we had inflation coming on the heels of the pandemic, which ate into the real spending, but the consumer was still spending more. And now, finally, I think what we are seeing is a leveling, and the consumer spending not more than the inflation level. And that's where we're seeing perhaps some softness in some of these discretionary categories, as well as some essentials too, like grocery.
Essentially, you're just saying don't confuse the process of normalization with something bad, something sinister. Is that a fair assessment?
I think that that is a fair assessment. And the truth is that it's not like we have seen spending fall off a cliff. And that's important. We had record levels of consumption fueled by, of course, stimulus payments, as well as the market doing very well. So the consumer was in a really, really good place over the last few years. And it would have to be something pretty catastrophic for spending to fall off a cliff at this point.
Sucharita, can you give us a sense of history and where this week it might be that we're looking at? You pointed to Walmart, Costco, and Amazon doing well at a time where consumers are increasingly cost conscious. Yes, they are executing well. Yes, they've got economies of scale that allow them to execute well. But how much does this indicate a shift in consumer spending that gives a hint of what's to come? Maybe not falling off a cliff, but maybe a sense of where we are in the deterioration of the consumer appetite.
Well, the thing that is difficult when you look at a Walmart spend or even Costco spend is that those are businesses that do well regardless of the economy. They do particularly well when the economy is doing poorly, but they do well even when the economy is doing well, because the consumer is spending more, and they're going to be beneficiaries of just mass merchandise spend. So it's difficult to say right now, looking at those companies, whether that is because the consumer is feeling more nervous and cautious. Certainly, all of the consumer confidence figures are a little wacky. And this is where we have the vibe session thesis that the consumer's feeling worse than the macroeconomic indicators are suggesting. We have to also remember that wages are still relatively high. Unemployment is low. GDP growth, we just had the GDP numbers for so far yesterday, and those were really higher than what the expectations were. So the economy overall is doing well. These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Just quickly, do we still see just as wide of a divergence from upper income families and their spending versus lower income families?
That's definitely one of the theses out there. Some of the softening is that it's happening at the lower end for sure. The lower end consumer is the one that not only is going to be more likely to have to resume loan payments, and they're the ones that are going to have the higher interest rates from credit card debt that they're going to have to cope with. But and certainly the upper income consumer is the consumer that is more likely to be a beneficiary of some of the stronger stock market performance of the last year. But at the same time, that upper income consumer isn't seemingly purchasing those luxury goods. Every luxury brand, which is a public company, has reported softening in sales, although arguably that could be because of the China consumer, less so because of the U.S. consumer.
Interesting. Sucharita, thank you. Sucharita Kodali there of Forrester. That's the important one, the important development for me. It's how much of the spending that's helped prop up this economy is starting to break down as well.
Yeah, that's the reason why maybe we're seeing airlines in particular not being able to win out with just some of the top-tier seats.
Coming up on the programme, a somewhat self-indulgent conversation with the AC Milan CEO.
Somewhat.
It's market focused, Bramwell.
It is. I've got lots of
questions. About the Russell and small caps and all of that good stuff. Let's start with the price action. 2 hours away from that opening bell. Equity futures pulling back by 0.75%, or rather pushing higher by 0.75%. On the Nasdaq 100 up by 1 full percentage point. And once again, the outperformance on the small caps, the Russell 2000 up by 1.5%. I mentioned this stat earlier this morning, and if you missed it, it's worth repeating again. It comes from Jim Reed at Deutsche Bank. The Max 7 down nearly 13% since a record high on July 10th. Since then, the small cap Russell 2000 has outperformed by a remarkable 24 percentage points over the period. And the outperformance, Lisa, continues this morning.
So that's the reason why, and I think you framed this perfectly earlier this morning when you said, ultimately, is this the beginning of a true correction, or is this a wonderful rotation that people have been looking for on the heels of economic strength? It's hard to really understand which. You can make a strong argument for either one.
Most people on Wall Street at the moment, I think, sort of like taking a tally of people on this program, they're saying rotation and broadening out, aren't they? I'm getting many people saying growth scare, with the exception of the economists who run this program saying they need to cut interest rates at the Federal Reserve, and they need to do so fast.
Former New York Fed President Bill Dudley among them, coming out and saying from the data that he has seen, they're at an increasing risk of being too late. This is really the key question. How do stocks respond to downside surprises? It seems like we have been in Goldilocks for long enough that if the Fed is prompted to cut because of weakening data, that'll be a problem for risk assets.
Let's turn to the bond market. In Treasuries at the moment, just about unchanged on a 2-year, 10-year and 30-year yield. The 2-year at about 442.86, the 10-year at 423. If you switch up the board, turn the page and get to the foreign exchange market, looking ahead to next week, not just a Federal Reserve decision, but also the BOJ with dollar yen at 154.65. I mentioned the range on dollar yen through the week. We've had a 157 handle that I believe was on Monday, Lisa, and we've had a 151 handle, which was the low of yesterday's session. That, for a currency pair like dollar yen, is a pretty wide range.
This used to be a haven bid. This used to be sort of the safe kind of place to go. And suddenly, again, it's trading as though we're an emerging markets currency. A lot of people wondering how much is technical unwinding of popular trades that we've seen in a number of different asset classes, and how much is hinged on this belief the Bank of Japan will raise rates next week. How much could it get reversed if the Bank of Japan does not make a move in next week's meeting?
Jeremy Stretch making that point, saying that this one could whip back in the other direction pretty viciously. That's foreign exchange for you. Under surveillance this morning, some top stories. A new Times Siena poll finding Donald Trump leading Kamala Harris 48% to 47% among likely voters. That's a marked improvement for Democrats when compared to the post-debate poll in early July that showed President Biden behind by 6 percentage points. So there has certainly been a bump in the last few days.
Yeah, although Libby Cantrell says we should just get a cocktail, go to the beach, come back in September, and then we could take a look at the polls. This aspect of it, that nearly 90% of voters said that they approved of Mr. Biden's decision to exit the race, was shocking to me. When have you been able to get Americans to agree, 90% of them, on absolutely anything? To me, this sort of highlights how, in some ways, the bump is coming from relief. Just that there is a different race than that everybody thought that there would be earlier.
I heard someone describe this situation. You know, when a CEO leaves a company and the stock rallies, and you always feel bad for the CEO. It has nothing to do with the new CEO. It's just like the old CEO's left and there's a relief rally. That's kind of the polls for the Democrats right now.
Yeah, people looked at the age. It was under 70, and they were very excited.
Yes, buy. Apparently, something like that. Let's get to the data. PCE and personal income and spending data due out in less than an hour. The last key data points going into the Federal Reserve decision next Wednesday. Economists surveyed by Bloomberg expecting both spending and income to grow at a solid clip, even as core PCE inflation slows to near the Fed's 2% target. That drops at about 8:30 Eastern time. And the Olympics kicking off today in Paris. Train services in France facing disruptions by what authorities have called a coordinated sabotage effort. Just hours before the inauguration ceremony, the head of the national rail company, SNCF, saying many trains have to be cancelled and about 800,000 passengers will be affected. This sounds like a nightmare in Paris today.
On so many levels, officials are saying this is less an attack on the Olympic ceremonies and more on just the French people who are all trying to go away from Paris to go on vacation. That there is sort of this feeling that this is a time when people tend to go away. Either way, it sort of raises the specter of how do they maintain security and order at a time where this is supposed to be the first actually regular Olympics. I mean, think about these athletes that previously were in Tokyo during the pandemic, swabbing and being isolated in little rooms. And yeah, a very difficult experience. This was supposed to be sort of the comeback games.
I don't know about you, but I've got absolutely no interest in going to Paris while this is on.
I would like to see, judo and table tennis.
Yeah, OK. We can go to that. We'll get some tickets. We'll drop in and drop out. Let's stick with sports. AC Milan meeting English Premier League club Manchester City in a pre-season friendly at Yankee Stadium tomorrow afternoon. It's the latest push into the United States by the Italian football giants, a market they've seen significant growth in since being bought by New York private equity firm Redbird Capital back in 2022. I'm pleased to say that joining us now to discuss is the AC Milan CEO, Giorgio Furlani. Giorgio, let's talk about this move. We've seen these friendlies before, AC Milan on tour, playing other teams from the Premier League and elsewhere. It feels like we're getting closer to playing a regular season game in the United States of America. Giorgio, is that true? How close are we to an event like that taking place?
Good morning. Thanks for having me. You're right. We do these tours in the summer regularly to play friendlies against other top teams. Look, there's regulatory challenges in moving abroad and into a different market, domestic league games. But we certainly think if you really want to develop a fan base and you really want to expand your business in the U.S., this would be a critical part. So we will be working with Serie A, our league, and the other regulatory bodies to allow us to.
You've mentioned the bodies you need to work with. Can you just build on that, the obstacles for something like that to take place? Have you had a meeting with Serie A and the regulatory bodies about this already? Have you taken steps to kind of push this forward? How close are we to something like this?
We certainly have discussed it with Serie A. It then needs to be discussed also with UEFA and with FIFA. And the authorities here in the U.S. There have been attempts in the not-so-distant past to play games. La Liga tried to, but it didn't work out. So we'll keep on pushing. It is absolutely important. Just in the same way that American leagues have expanded globally by playing regular season games, not just friendly outside of America, we need to do the same the other way around.
Giorgio, I've got to say, we just saw basically a mini World Cup. We saw the Euros. We saw also Copa America taking place at the same time. Pretty much everyone who I knew on the weekends was watching some of the games as they really got into it. The enthusiasm, though, in the United States for games that were held here was surprisingly not very strong. We didn't hear that much about games that were happening nearby. Have you been disappointed by how some of these games have rolled out at a time when there certainly is more interest, but maybe not in the way that there is in many of the other markets around the world?
Look, I think the ultimate test will be the World Cup in 2026, which will be and that is really the top content together with top games of European continental leagues. And
Giorgio, I think that we're having some trouble with the sound. Let's just try to reestablish that. Then we'll get you back real quick so that we can make sure that we understand everything. But this has actually been part of the issue, John, that people have been talking about, which is essentially we've had these games in the U.S. We're preparing for the World Cup at a time where Copa America wasn't very well kind of advertised in a sort of significant way. And it raises this question. how the U.S. hosts the most important games for the majority of the world in a country that emphasizes other sports.
These clubs have been trying to pivot to the United States for a long, long time. It's amazing to me that the world's number one sport is football. But if you look at the most valuable franchises on the planet in sport, a lot of them in the top 10 are American sporting franchises, American football, baseball, etc. There's a lot of money here, which is why they want to be here. If you look at the sort of evolution of what Milan have been doing, they're also investing in US talent. So they have the premier soccer star, which is Pulisic, on the roster now. Not a single AC Milan player was in that Italian national team at the Euros this summer. They've invested far more on the US side of things than maybe they have in Italian youth. And we can get Giorgio's opinion on that if we can re-establish the connection, because I'm sure he's got strong thoughts about it. But that might be a criticism of some of the moves that they have made over the last few years.
Yeah, one of their top players is a United States player, which creates this issue. How do you maintain the kind of enthusiasm that some people, even if they're growing up in England but have relatives that are in Italy, can still have if you don't have sort of a homegrown base?
Giorgio, let's come back to you. I'm happy to say that if you are just joining, we are still with the AC Milan CEO, Giorgio Furlani. Giorgio, I know there was a little bit of a technical connection, but I want to come back to some of the comments we were having around the table. It feels like AC Milan has become more American in the last year or so, and maybe less Italian. The very fact that there wasn't a single AC Milan player on the Italian roster at the Euros this summer, is that a financial decision or a sporting decision?
Very good question. We've definitely become more American. We're owned by an American firm, which is Redbird Capital Partners, which is a leading investor in sports media and entertainment, and we work very closely with them. We've also become more American on the field. So we have, I think you were saying, 2 American players. Our decisions on who to field are entirely sporting. So there isn't a decision on the base of, what passport a player has, but it's about how good the player is. Obviously, some players, just by nature of being American, in our case, we have 2 players, including Christian Pulisic, have a certain commercial appeal in the US, which is certainly helpful. But we don't drive sporting decisions by passport list.
We were talking, Giorgio, about how the United States is a really expensive market, that there's a lot of money here. And so that's one reason why a lot of people want to come here, is because there are dollars and a lot of eyeballs to come. There are also a lot of dollars coming from the Middle East, and you're going to be facing off with Man City. Giorgio, how open are you to tapping the seemingly endless appetite in the Middle East to own clubs in Europe?
So we tap in the Middle East in a different way, which is on the commercial side. So we've opened an office in Dubai. We're the first European football club to open an office in Dubai. We've had a long-standing 15-plus year relationship with Emirates, the airline. We have other commercial partners in the region, including the Kerzner Group. And so the way we've gone about it is not sort of via, let's say, equity injections, but rather via commercial partnerships.
Giorgio, I just want to squeeze in one final question, and I'll ask this as an AC Milan fan, a lifelong fan like yourself. We both remember the AC Milan of Capello and Sacchi, of Baresi and Maldini. We've both been disappointed with the performance of the team over the last 20 years and the trajectory that we've been on. I remember when the club became a selling club, and I identified that summer when we sold Ibra and we sold Thiago Silva to Paris Saint-Germain. It felt like that was a moment where AC Milan became a club that needed to sell players and couldn't buy that talent anymore. This summer, we've got 2 big players, the left-back Theo Hernandez, and we've got the goalkeeper, Mike Maignan. I want to understand whether that's 2 talents that you need to monetize to fund the rest of the project, or whether AC Milan is back in a position where it can keep world-class talent. Just what is the state of play?
Yeah, so look, on the sporting side, our ambition is to fight for the title in Italy every year and to be competitive in the Champions League. Now, we do this while on the, let's say, other side, running a business that is sustainable. So to give you some facts, 2 years ago was the first year in which AC Milan was profitable, first year in 17 years. And last year was the second year. And I don't think it's ever happened to AC Milan to be profitable in 2 consecutive years. What that translates into is we're not forced to sell players because of capital shortage or cash flow issues. So, picking one word, you say we don't need to sell anyone. So as a fan, I'm telling you, you shouldn't be worried about that.
Well, as a fan, it's good to hear. Giorgio, good luck tomorrow, and hopefully we can catch up soon. Giorgio Furlani there, the AC Milan CEO. Let's turn to some stories elsewhere for you this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Starting with some earnings, Bristol-Myers Squibb jumping in the pre-market trade by nearly 5%. It raised its 2024 profit forecast thanks to demand for its new medicines. And there had been questions about future growth of Bristol. Its key drugs face stiff competition and new pricing pressures. But all of its biggest medicines beat sales expectations, while the company said its cost-cutting initiative is starting to pay off. Just over 100 days to go until the election, and a September 10th debate is still on the schedule, but Trump isn't committing just yet. Trump's campaign says it would be inappropriate to commit to the debate until Democrats formally nominate a new candidate. Trump also said he wanted an organization other than ABC News to moderate it. Democrats are poised to virtually nominate Harris and her yet-to-be-named running mate by August 7th. The vice president said yesterday she was ready to debate Donald Trump and accused him of backpedaling from an agreement. SpaceX's Falcon 9 is cleared for takeoff. The uncrewed rocket won approval from U.S. air safety regulators to return to space. On July 11th, a mid-flight failure had grounded the world's most frequently launched rocket. The company, led by Elon Musk, aims to launch as many as 148 flights this year within its Falcon rocket family. SpaceX says it is ready to return to flight as soon as tomorrow. That's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines. To us, that flies in the face of this recent rotation into small caps and risk-taking.
That conversation up next, live from New York. You're watching Bloomberg Surveillance. Equities look like this on the S&P 500, firmer by 0.8%. We're picking up here. Elsewhere, the outperformance on the small caps once again this morning going into the opening bell. In the bond market, yields just about unchanged, the 10-year 423.48. Under surveillance this morning, a turbulent summer travel season.
We've seen this theme of transportation stocks missing, whether it's airlines, American Airlines, Ford today, Tesla recently, and even UPS. So companies with heavy cyclical exposure to the economy have been disappointing. And to us, that flies in the face of this recent rotation into small caps and risk taking.
So here's the latest. It's been super difficult for the airlines. American Airlines reporting disappointing earnings, slashing its profit outlook after overestimating demand for domestic travel. This as Delta returns to normal operations following last Friday's global tech outage that led to thousands of cancelled flights. Joining us to discuss this industry, Sheila Kahyaoglu of Jefferies. Sheila, it's good to see you.
Thank you for having me.
Where do you want to start? Delta come out and say things aren't great. And then United come out and say the same things. And I'm thinking, well, we're going into American now. Surely we've lowered the bar enough and the market's looking for this. And then American come out and say things are pretty bad and the stock craters. Have we not lowered the bar enough for these airlines still?
It keeps getting worse. Air France pre-announced negatively yesterday on the Paris Olympics impact. Air Canada, Lufthansa cut EBIT by 50%. So it keeps getting worse, especially in the Atlantic yields. There's more competition, and that's what's been holding up on the international side. But American and Southwest really have both had strategic missteps. American realigned its corporate strategy and it decided to go direct, and it really missed out on revenue points. So they're going back into that, adding sales force, which they've cut over the last 2 years. Southwest is Southwest. So they've had some strategic issues. And what they're doing, yesterday they said they're going to add premium seats. So instead of an aircraft with 175 seats, they're going to go to 160, which is like the Delta and United average, add extra rows of legroom, and change their onboarding strategy a bit.
It's Southwest welcome to the 2020s, like 4 years late.
Yeah.
What do you make of the timing of these executions from both American and Southwest?
I think they're realizing they're losing out on market share and their yields are worse than everybody else, so something's got to give. It's just a matter of how quickly can they do it. I think American can do it faster. You know, as a corporate booker, I don't know how quickly, I don't know where Jefferies is booking my American Airlines flight to Heathrow at this week. So I think it's easier to regain that. Southwest is really shifting its strategy with assigned seats. And don't forget, they make about $1 billion of revenue out of their $24 billion of revenue from early board booking. So they could lose that revenue. So it's unclear how quickly Southwest could actually take share back.
So this is totally off script, but you mentioned Air France and you talked about how the bookings have actually gone down because of the Olympics. Yep. I don't get this. They're not the first to say this. We've talked to others who also say that actually travel is going down because of the Olympics. Isn't it supposed to be the opposite? Isn't
that's what I thought too.
Of cities becoming the host cities for Olympics being that it increases traffic?
Yeah, and Ed Bastian at Delta told us otherwise. Delta has a Paris hub, so that's why it's more impacted than everybody else. But apparently no one's going to Paris this summer, and even if they are, they're not doing multi-leg flights. So they called out about $100 million in impact. Air France called out a bigger impact. I think it's a one-time thing we could look through, but yeah, I would assume the opposite as well.
There's a question right now, not just about execution and profitability of some of these airlines, but also how do they maintain morale at a time when there are some snafus? We're talking about Delta and the issue around CrowdStrike and the fact that some of the employees didn't really feel like they knew who to call. Now, United Air is requiring a doctor's note to call out sick for pilots, and that's now being reviewed by federal officials. I'm just wondering, is that a problem at a time where execution kind of depends on these people?
No, just listen to an airline earnings call. They sound great. Peak revenue, all-time high revenues. You wouldn't know anything is wrong with an airline by listening to an airline earnings call. Things sound absolutely lovely. Revenues are at all-time highs. It's just
Where's the disconnect here?
I think that's, you have to look at profitability and what profitability looks like, what cash levels look like. American and Southwest are draining their cash balances. American won't be able to delever. Southwest keeps buying more planes. But I think, in any industry, airlines, pilots are have a great morale, so the flight attendants, and they also have contracts that they just put into place. So most of the airlines have their contracts in place. American has another cost headwind coming up. It's going to look to ratify its flight attendant contract, so that's going to be a headwind for the second half of this year and into 25.
You really don't sound impressed with the way that Southwest is run. Is that fair to say?
I think running an airline is an extremely hard job because you book and ship right away. Prices swing 10%, and your 1 point of price is 10% of EBITDA. So you could really mess up an airline very, very quickly. So I don't envy those who have to run an airline.
You have sympathy with them, but is there something about they're running their business versus, say, Delta is that means they're performing this poorly?
I think if you focus on premium, it's a more steady base and you have that pricing cushion. So, any mistake in the domestic markets, if you put too much capacity, you're making up for it in your international side where you have 20% operating margins. So I think that's where they have a little bit of cushion with Delta and United. And they're just bigger. They have brand loyalty. They have the credit card. They have their Delta Tech Ops, so that's their maintenance business. That if they spun that off, that would probably be worth $10 to $15 billion. So they have a lot of. That just tells you what Delta is worth. If you strip away Sky Miles, you put it at a Visa multiple, and you looked at their Delta Tech Ops business, it would mean Delta Airlines as an airline is not worth anything.
Lisa's asked this question a million times. They sound like credit card companies now. Why don't they just say that they are credit companies?
They try.
Wouldn't they be better off?
I think they're really pitching that, and you saw that with United. It took out the leverage that was associated with its credit card business to essentially unencumber the asset. Granted, it was an 11%, note, so it was saving them a lot of interest to put away that debt, retire that debt, but still.
From a broader perspective, just sort of zooming out, we were speaking with Sucharita earlier of Forrester Research, and she was saying that on the margins, you are seeing some pushback by even the higher end consumers. Maybe this has to do with China, LVMH. We saw Gucci, really underperforming. Are we seeing the same kind of spending patterns at the highest end of the cabin, which really had been sort of the mainstay for profitability for a lot of these companies?
I think that's what everybody's worried about with airlines, right? They're not giving them the credit for the premium offering. And we cover the business manufacturers, Textron and Gulfstream. They both reported book-to-bills of 1.0, but you didn't see an acceleration in orders for the biz jet. So is that hitting the high end? You're seeing flight Flight utilization for business jets up versus 2019 levels, 20%. But year over year, they were down 1%. So is this kind of a leveling out of even the high end, which the consumer brands would tell you it is?
Sheila, you've been busy, that's for sure, over the last week. Sheila Kahyaoglu there of Jefferies. Think about the changes we've seen in the last week. American, another disappointment. Southwest, a change in policy. Delta, struggling to recover from the issues that we were talking about in this show a week ago.
You asked the right question about Southwest. What took them so long? I mean, at a certain point, I understand it's the culture, and I'm sure that they're getting a lot of backlash from people saying, come on, now you're going to join everybody trying to bifurcate people according to how much they're willing to spend. And Southwest would say, yeah, because we need to make money. And guess what? That's how people do it.
Still the most confusing one for me out of all the airlines in the States. You know which one I'm going to name? JetBlue. I don't understand JetBlue. They have got a serious branding problem. If you go on a JetBlue flight, the customer service is absolutely phenomenal. You and I both shared a flight, transatlantic to London, fantastic flight, flew business with work, thank you, with work, and it was fantastic, it was brilliant, it was up there with the likes of Delta, with the likes of American, and I just don't feel like that they market that well enough in any way, shape or form.
Because they want to cater to families. Look at their routes going down to Florida, going down to the islands. That's the sort of, you go and people put on hats and they're with their families, they're excited, it sounds really nice.
But they sound budget when they're not. Do you know what I mean? They're sort of like,
It's like big box stores trying to look cheap.
Yeah, I don't. Anyway, coming up, less on JetBlue, less on AC Milan even. Up next on the programme, Sam Stovall of CFRA.
Throughout this earnings season, there is absolutely zero tolerance for anything that even smells of weakness.
Those mega cap techs have unbelievable return on equity. But nonetheless, trees don't grow to the sky. These things can revert really quickly.
You have lofty expectations, you have lofty valuations. Investors will continue this unwind trade.
The concerns are valid. I do think there's frothiness in parts of the ecosystem.
The earnings season so far has still been really solid, and that speaks for other sectors really to participate as well.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell and about 30 minutes away from some economic data in America. Let's turn to the price action. Equity futures on the S&P 500 firmer by 0.9%. The Nasdaq bouncing back by a little more than 1 full percentage point, and the Russell of small caps flying once again, outperforming. We're higher by 1.7%. The only question that matters around this table at the moment: what is the state of the US consumer? Andrew Hornhorst City saying this: continued solid consumption will depend on the labour market. And we're all looking ahead to that payrolls report next Friday. This is what him and the team are looking for. 150k on payrolls, but they're looking for the unemployment rate, Lisa, to climb back up to 4.2%.
Potentially triggering the SOM rule, which we heard from Bill Dudley is one of the key reasons why he feels like there is renewed urgency for the Federal Reserve to cut rates, even though Claudia Sahm herself has said it's just, one benchmark. You shouldn't really take it as necessarily gospel. I will say, even heading before the jobs report, we get personal income and spending in about a half hour. And really, I feel like we got to bring back toxic brew, because it feels like with thin liquidity and this idea of, uncertainty around the trajectory of the economy, one bad print one way or another could really cause a pretty disproportionate response.
It's been a while since we talked about toxic brew.
I think it's time to start, reflecting on it.
Let's talk about what's in the brew. What's in the brew right now?
We've got a situation with earnings that are inconsistent across the board, some winning, some losing. Maybe it's execution, maybe it's consumers pushing back a little bit more. You have unemployment rate that's creeping higher, albeit at a normalizing pace. We have claims that are inconsistent, but still just nudging up. And then you have this situation where if you look at financial conditions, they are tightening. They're at some of the tightest paces just based on the recent sell-off so far this year, but still companies are able to borrow. Capital markets are open and credit spreads are tight. This is a potentially confusing brew that could easily turn into a toxic brew with potentially certain negative prints.
It makes it really difficult to answer the question we asked 3 times to 3 different guests yesterday. Is it a rotation, a broadening out, or a growth scare? And when you point to credit spreads and say they're tight, that says things are okay. That supports the idea this is just a rally that's broadening out away from big tech. When you see what's developing in rates markets at the front end of the curve, that rally off the back of the prospect of maybe getting some bad data at some point in our future, didn't get it yesterday, maybe on Friday, you start to wonder if it's a growth scare. And that's going to be the debate we have right the way through the summer into Jackson Hole, regardless of what the Fed says next week.
And here's the rub. We don't really have the answer. I mean, even Michael Hartnett, who has had a bearish tilt for quite a while, has basically said we're one bad data print away from big tech, leading the whole index lower. When people talk about short term, a lot of people say that there could potentially be momentum in some of the sell-off, albeit it won't necessarily be a lasting sort of situation. Key thing is people don't have visibility. So how do you have conviction? How do you have anything other than tactical at a time where there's very little visibility?
We haven't talked about toxic brew for a long, long time. Throwback.
I know. I think it's not quite toxic, but I think that it's definitely a brew. It's not,
all of that.
Yeah, I think it's
toxic brew, tank chasers. As for the tank chasers, by the way, TK joining us on the Fed show next Wednesday afternoon. So look out for that. Sort of reunited for one special edition of the Federal Reserve decision and then back again together for the Jackson Hole meeting at the end of August. Let's get to this. Let's get to the price action. In the equity market right now on the S&P 500, firmer by 0.8 to 0.9, call it 0.85 on the S&P. In the bond market, the 10-year 423.87. In foreign exchange, the euro just a little bit stronger, 108.62. Coming up this hour, we'll catch up with Sam Stovall of CFRA as the equity bull market hits a bit of a wall. Republican Senator Bill Hagerty as D.C. tries to predict a Trump 2.0 cabinet. And Mark Zandi of Moody's Analytics on why too high for too long is starting to crack the U.S. economy. We begin with the big issue, the tech-led rout pausing as investors await PCE data out in just under 30 minutes' time. Last week's rotation continuing as investors confront disappointing earnings. Sam Stovall of CFRA has this to say. The lofty initial expectations for second quarter earnings growth have caused some mega cap high flyers to fail to clear this elevated bar, causing investors to wonder if other mega cap disappointments should be anticipated. Sam joins us now for more. So Sam, let's get to the calendar. Let's go through next week. Microsoft, Amazon, Meta, Apple. Do you think we're set up for some disappointment here?
Hey, Jonathan. Well, certainly next week, 40% of the cap weighting of the S&P 500 tech sector will be reporting earnings. Even though expectations are that we've seen a better movement in earnings for the technology sector now at about 17%, up from 16% and change, I think, investors will definitely be paying a lot of attention to what is said and implied with these upcoming earnings. The chip companies typically do have some challenges when it comes to third quarter areas. And our feeling is that, while there could be some stumbling, we are maintaining our overweight recommendation on tech, mainly because companies will soon be looking at 2026 estimates and pretty much ignoring what they're hearing right now in 2024.
Sam, let's take the earnings so far this week. Let's pick out one name. Let's talk about the likes of Alphabet, and we can think about how the way the market responded to what Alphabet had to say. Based on that, what are investors in the mood to reward and what are investors in the mood to punish? And I think that's something really interesting that we've got to try and answer in anticipation of the earnings next week, because it felt like investors were in the mood to punish excess investment out of Alphabet, whatever you would call excess. I want to understand how that might set us up for next week, Sam. How do you think about that?
Well, I think what that implies is that investors are really only looking short term, because the investment that Alphabet was making is obviously for 2025, 2026, which is the cause for our optimism longer term. But in the near term, investors are basically saying that recently we had tech selling at a 78% premium to its average 20-year PE ratio, the market itself at a 38% premium, and the relative strength between the cap-weighted tech and equal-weighted tech sectors were back to where we were during the dot-com bubble. So I think that investors are saying if there's any hint of disappointment, I'd rather sell first and ask questions later.
Sam, I guess another way of putting this together is how low is the bar right now heading into next week for some of these earnings? After the sell-off we've seen, a true correction down about 13% since the July 10th record highs that we saw in the Magnificent Seven stocks. How much do you anticipate that any additional disappointment or even just not superlative type of results will provoke some pretty significant selling in addition to what we've already seen?
Well, I'm looking at history. I would tend to say that we are due for a double-digit decline in the order of 10 to 13%, primarily because of the advance that we experienced in the first quarter, as well as for the first half, and as I had mentioned in terms of the valuations. However, I do think it'll be contained to a correction, not the beginning of a new bear market, and would probably end up representing a good buying opportunity as we approach the fourth quarter of this election year. Let me also mention that when it comes to elections, there's the possibility of a red wave. And whenever we have had waves in the past, we've had 3 Republican waves since World War II, 7 Democratic waves since World War II, that has added a percentage and a half to the average return in the first year of a new administration.
So let me get this right, Stam. A lot of people are saying that a red wave or a blue wave, but in this case, a red wave, would actually cause inflation to go up and could become a problem for the bond market. You see it as the opposite, that actually any kind of dominance in Congress would actually lead to greater returns in equity markets. Is that correct?
That's what has historically happened, but obviously it's going to depend on what the new administration puts forth. If we do see, in a sense, very high walls in terms of tariffs and whatnot across the globe, then yes, that will end up being very restrictive, would be a hurt to our exports, would certainly smell of, or have the sniff test of the Smoot-Hawley tariff back in the early 1930s, which restricted global trade. So I don't think that would be a very good thing. And I believe that those who end up being in power would be very much aware of that.
Sam, just taking a step back, it seems like you're still pretty constructive on the overall backdrop for the U.S. economy. It doesn't seem like you're sort of expecting a major fall off the cliff type of moment. What would you have to see to change that view for some of the growth worries to become a true growth scare for you?
Well, as I had mentioned, the valuations were stretched, in my opinion, 78% premium for tech. Now it's down to about 64%. So some more slight downward rotation for tech, I think, would be encouraging. I think if we get a softer than expected PCE reading this morning, that could also help talk the market off the ledge. And because we've been seeing an improvement in the rotation beneath the surface, our Lowry technical analysis arm has been showing an encouraging amount of supply-demand indicators that they monitor to say that while a short-term pullback could certainly be in order, that they are looking at that as a good buying opportunity.
Let's see what we get in 20 minutes. Hey, Sam, thank you, sir. Sam Stovall there of CFRA. This from Ian Lincoln of BMO. He says, happy anniversary. I opened up the email thinking, what on earth is he talking about? And then he said it was exactly 1 year ago, July 26, 2023, that the FOMC brought Fed funds to this cycle's terminal rate of 5.25 to 5.50. Also the anniversary of the Draghi whatever it takes Bumblebee speech.
Yeah.
Back in 2012. We're going back a long time, aren't we? 12 years.
So at this point, I'm wondering how long beyond this are we going to see a difference in the Fed funds rate? And I guess a lot of people are expecting it is not going to be next week. But can you imagine if it were a full, 1 year kind of pathway?
And they cut rates?
Really, yeah. And then it would be this sort of very...
Just perfect.
Yeah, it would have this sort of,
I
arc
think that's
to it,
how other
narrative
people
arc.
think about this. I was just reflecting on the Draghi speech, the Bumblebee speech back in 2012. I know people who were in the room, and the people in the room at the time didn't feel like it was a big deal. That's what was amazing about that speech. People at the time didn't feel like it was a big deal. And then it was like the days afterwards that we started to put together, hang on a minute, is he going to come together with some big plan here that's going to turn around the whole story? Lifetime ago. Can't believe that time has gone by as quickly as it has. 12 years. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of 3M up some 6.6% in the pre-market trade this morning. It reported second quarter net sales that beat estimates. It also raised its full year profit forecast. It's the first earnings report since Bill Brown took over as CEO. Brown saying accelerating sales growth is a priority and that he wants to get there by increasing the pace of new product development. Now, as the Olympics are set to kick off in Paris later today, French authorities are contending with what they're calling malicious acts targeting the nation's high-speed rail systems. Fires were set at several infrastructure hubs along the rail system. Officials say people were seen fleeing the sites in vans. Eurostar says its services to London and Brussels have been impacted, with several trains delayed or canceled. The national rail company says it will have to repair its network cable by cable. Vice President Kamala Harris has picked up another key Democratic endorsement, Barack and Michelle Obama. Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama held back. A person familiar with his thinking telling Bloomberg that he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls. Plus, we'll catch up with the Republican Senator Bill Hagerty on possible Trump 2.0 policy initiatives. That conversation up next. This is Bloomberg. Live from New York, counting it down to the opening bell with equity futures positive here by 0.8%. Yields unchanged on a 10-year, 424.26. The opening bell about 1 hour and 14 minutes away. Let's get you some morning calls. First up, Evercore upgrading CBRE to outperform with a 123 price target. The analyst noting the real estate services firm appears to be turning a corner thanks to upbeat second quarter earnings. The second call from Phillips Securities downgrading Tesla to sell and lowering its price target to 135. The analyst seeing further margin headwinds due to soft pricing and EU tariffs on China exports. And your third and final call from Guggenheim, lowering its price target on Chipotle to $54, maintaining a neutral rating. The firm lowering its 24 and 25 EPS estimates for the fast casual chain, seeing softer margins offsetting modestly higher same-store sales. That stock just about positive by 0.7%. Let's turn to the election. Sunday marking 100 days until voters head to the polls. If re-elected, former President Donald Trump is widely expected to appoint a so-called Capitol Hill cabinet, which could be full of congressmen. That includes Republican Senator Bill Hagerty, who is being floated as a potential pick for Treasury Secretary. The senator joins us now for more. Senator, it's wonderful to catch up with you, sir. I understand you are attending the cryptocurrency industry conference in Nashville, and we'll touch on that in just a moment. I just want to gauge where you sit on certain issues in foreign exchange, Senator, given our conversation with the former president of Bloomberg Business Week in the last week. The former president, Donald Trump, said this about the currency. He says the United States has a currency problem. I understand we have a technical issue with the senator. Can the senator hear me still, even if we can't see him and the shot is frozen? Can you confirm that? We can't hear him either. OK, so we've got a bit of a technical issue. We'll try and confirm a re-established connection in just a moment. The conversation I wanted to have was around foreign exchange, Lisa, and the first question would have been, and I'll share that with you right now, ultimately, if we've got a currency problem, what can they do about it in Treasury?
Yeah, especially at a time when ultimately this is about the Bank of Japan holding rates incredibly low and the U.S. having a strong economy. Potentially, how do you further the idea of a weaker dollar if you do pursue some of the policies that Donald Trump has talked about, including higher tariffs, including reducing certain immigration?
Deutsche Bank have this to say. Tariffs and their associated stronger implications for the dollar are significantly more likely to be the dominant market outcome than policies to pursue a weaker dollar. And this is the issue at play here, almost a contradiction. You identify a problem, you think it's the currency, ultimately it's too strong, but you also propose some policies that could strengthen it in the minds of a lot of people that come on this program.
Part of the problem to really understand where the former president is sort of thinking is if you do have two contradictory policies, which is more important? Is the idea of a weaker dollar and potentially more exports more important, or is the idea of putting up some gates for products coming in here from, say, China and potentially reducing immigration?
I'm happy to say we've re-established that connection with the senator, and hopefully we can get across to him now. Senator Hagerty, do you hear me OK? He does not hear me OK. I think we're going to let this one go, because I don't think we can establish this connection at all. Senator Hagerty there on the latest from the cryptocurrency conference in Nashville. We went through some of the prices to attend some of this fundraiser. I shared them with you a little bit earlier. I think it's worth going over again. Donald Trump's going to be there, and he's inviting supporters in a private fundraising event to Nashville on July 27th. And it includes this, asking $844,600 for a seat at a round table. Donors can also get a photo, a snap with the presidential candidate for $60,000 per person and $100,000 per couple. That's some real money they could be raising this weekend at a time when we've seen the figures coming out of the campaign for Kamala Harris, or Act Blue, to be more precise. Some real numbers since Sunday.
It raises a question about this particular forum, right, and sort of the connection that it has. Crypto assets in particular, sort of hot topic for a long time and then took a little bit more of a back seat. The idea of where the role comes into play and kind of where government oversight comes. I mean, this to me is compelling to me, this idea of, are they looking for less regulation? What is the purpose of crypto assets going forward? And, you know, I mean, I guess that it's just sort of an interesting moment for that to be in the fore.
There is a kind interpretation and a less kind interpretation. The kind interpretation, to your point, is that they want some regulation. The regulation they've been asking for, they want things to become more predictable. They want to build this out. They think it could be beneficial to the broader economy. The less kind interpretation is that the cryptocurrency world has identified an administration that could introduce some policies that destabilize the US dollar and would be advantageous to the price of Bitcoin. So, like all things to do with politics, pick your poison. Is it the kind interpretation of what's happening here, or the less kind interpretation?
And I will let everybody make their decision. When you zoom out, there is this real question, and I think that we've seen this again and again, where there isn't a clear candidate right now for president that is clearly business friendly. It is unclear who the business-friendly administration actually is. I think that we have to keep asking that, and I think that actually, I hope that we can at some point talk to Senator Bill Hagerty. Maybe not today, but at some point get him back on, because he has been of the business world. And I have this real fundamental question of, especially at a time of protectionism on both sides of the aisle, especially at a time when you have a real fraught national security moment, how do you become the party for business? What does that mean? Sometimes it can just be consistencies of policies. Does it mean the idea of putting up gates or not? We talked to Stellantis yesterday saying that actually tariffs hurt their business, even if they reduce competition in the short run from China. So a lot of real questions around some of the traditional associations in the political parties and how they're really changing.
When we say the party of business, my response would be, what business? If we're talking about big tech, not the party of big tech. If we're talking about small business, David Malpass, former World Bank president, in the running potentially for a role in the next administration under Donald Trump, around this table talking up what? Small business. They want to help small business. It's not about being pro big tech. So the party of business, but certainly not big business anymore. And I think that's the populist bent in this party that's pushed them in that direction.
Yeah, it's a good point. And I wonder how much it's small business versus large, or whether it's specific industries that have certain projects that are positive or negative for certain bases. Either way, I think that when you talk to a lot of politicians, they're saying, pick one. Pick a policy and stick with it, because if you want to make plans, you have to be able to count on a landscape that is not shifting at every administration, every couple of years. I do wonder how much, though, that really has changed the tenor of some of the conversations of bank CEOs, of industrial CEOs who go to the White House, who speak with the former President Trump about what policies they'd like to see.
Let's make some plans on this program. In about 7 minutes' time, we get some economic data. Let's go through it. Personal income, we'll get PCE. Then a little bit later at 10 a.m. Eastern time, we get University of Michigan sentiment numbers as well. That sets us up for the last big slate of data before we go into next week, when we get a Federal Reserve decision. And 2 days after that Fed meeting, a payrolls report in the United States of America. The estimate on our side of things for payrolls in our survey, 175,000 is the median estimate in our survey. The previous number is about 206. Into the numbers we get in about 6 minutes' time. Let's turn to the price action and start with equity futures. On the S&P 500, we look like this. We're positive by 0.8%. On the Nasdaq 100, up by 1.1%. On the Russell, the small caps, monster outperformance once again this morning, higher by 1.4%. If you look at the price action, the outperformance we've seen over the last few weeks, and I've gone over this stat a million times, I think it's worth going over again, from Jim Reed at Deutsche Bank, 24 percentage points of outperformance on the Russell 2000 versus the Mag 7 since the record high back on July 10th. Lisa, that's mega outperformance.
Yeah, and it comes after a mega underperformance earlier this year. This is the reason why the main question for so many people has been, is what we're seeing right now in markets really good and actually shows that a healing economy is going to let some of the other companies other than big tech really benefit? Or does this begin a sort of downward spiral that at least can cause a deeper correction? The answer has been unclear.
Mike McKee dropping by the studio ahead of this break in economic data. Mike, we've had some data already this week. GDP was better, jobless claims a little bit lower. What are you looking for from the numbers later this morning?
Better. It's a good way to put it. We're expecting a slight decline from the PCE inflation numbers, although this is going to be a 3-digit issue here today because there are some questions about whether they might come in stronger than anticipated because of rounding effects. You know, it's a 0.1% change for the PCE price index, but if it's 1.6, then it's going to round up to 2. And that might worry some people. But in general, we're expecting overall inflation to be down and spending to be reasonably good because we saw that in the GDP report yesterday.
In 30 seconds, was yesterday's GDP print as good as it was, as people thought that it was on its face?
It's better than I think some people are looking at because a lot of it was based on consumption, and that's what the Fed wants to see. People were not necessarily pulling back. They're spending a little less, but it looks reasonably good. So overall, not too bad. And the good news today is this is an 8:30 number, and everybody can head out to the beach or whatever relatively early today.
That is the good news, unless you're hanging out for you, Mitch.
Well,
are you hanging out for you, Mitch?
Yeah, I am hanging out.
Okay, good for you.
But after that, we'll go. And then we can go home and, you know.
Some of us are not hanging out for you, Mitch. All right, breaking economic data up next. We'll catch up with Mark Zandi at Moody's. Mike McKee will break this down. That's all coming up next on the show. Economic data seconds away with equity futures on the S&P positive by 0.8% and the Nasdaq up by a little more than 1 full percentage point. On the Russell, positive by 1.4. That's where your outperformance has been. It's where it is this morning. In the bond market, a 2-year, 10-year, 30-year shaping up as follows. The 2-year yield higher by a basis point, 4.43, call it 4.44. And in the bond market on a 10-year, just about unchanged at 4.23, 4.22.70. With that economic data, Mike McKee around the table. Mike McKee, what have we got?
We've got a little bit less than anticipated in terms of personal income, and spending comes in as forecast. Personal income up 0.2 and personal spending up 0.3. Now, the numbers that everybody really wants to see. PCE price index comes in spot on, hits on the screws, 0.1% for the increase in June. Same as forecast. The PCE over year, 2.5%. That is as forecast and down 0.1 from last month. And then the core comes in 0.2 as forecast and 2.6%, which is a little bit higher than the core forecast for the year, which was 2.5. So that's probably where that rounding error comes in a little bit. But income spending were also revised a little bit lower. Well, income was revised lower for the month of May, and spending revised higher for the month of May. So at this point, you've got a reasonable incomes, good spending numbers, and prices continuing to inch down. They're not going really fast, and that's the thing that a lot of people are hoping for, but maybe this is enough to get the Fed going.
If we just take a step back and think about what the last 24 hours has looked like, Mike, before the economic data yesterday, a hot GDP, and a decent jobless claims relative to expectations, there were these massive calls to get a move on at the Federal Reserve. And we can go through these calls piece by piece. Mohamed El-Erian came on this programme a month or so ago and said, I think they need to move in July. There's a risk here that the labour market weakens and weakens quickly, and they need to get ahead of all of that. Jan Hatzius of Goldman Sachs asked the question as well, why wait? Bill Dudley, the former New York Fed president, wrote an opinion column on Bloomberg Opinion saying, I've changed my view based on the labour market. They need to get a move on. I remember you saying yesterday when the jobless claims numbers dropped, it's almost like for the Federal Reserve, what do you want us to do? The numbers look okay. Where does that argument stack up now? How does it stack up going into this meeting next week?
This doesn't really change anything. The spending numbers aren't strong enough to say that we're not going to get rid of inflation because the economy is overheating. The income numbers show a little bit of a decline, and we'll have to look at what the overall composition of that is. I've just got the numbers here. Wages and salaries up 0.3. That's down from a 0.6 gain in the month of May. So a little bit better there in terms of what you're looking for in inflation. Savings rate 3.4 from 3.5. You know, this is all not a collapsing economy that you need to immediately rescue. It is one that is slowing down.
And we can see not much of a reaction in markets, just a little bit on the margins. Yield just a touch lower, but coming back. And John will go through all of that. But I'm looking right now at this data, and it points to this idea, slowing, not slow, right? But the stickiness in core PCE, does that make anyone take pause? I mean, there's this question of, can we really write off the idea of a resurgence in inflation if you do have certain goods inflation aspects coming up just as services inflation goes down?
Well, services inflation is still hanging in there is the problem, and goods inflation has fallen quite a bit, but everything is moving down slowly. And we're got to be at a point sometime soon, given that Jay Powell and others at the Fed have said we're going to have to start lowering rates before we get to the 2% target. I mean, we're in range now. He has said 2.5.
You've made the point also, Mike, that you think to some extent this market's already doing the work for them, that all they need to do next week is just sort of validate what the market's priced for. Is that fair?
I think that's the case. If they suggest strongly in the statement or Jay Powell's news conference that we're going to see a September rate cut, then their market's going to price that in, and they're going to get the effect of a rate cut in July.
Going into the next week, we have a lot coming up. We've got, of course, the FOMC meeting. We also have the Treasury refunding announcement, and we've got some of the tech earnings capped off with the jobs report on Friday. From the Fed's perspective, how much are they watching some of those pivotal earnings, given that the signals from corporate executives have been some of the most forward-looking indicators that a lot of economists have hooked into?
Well, they'll pay a lot of attention to it, and they're always talking to the CEOs in their districts all the time, and the Board of Governors is out talking to people. So they have a pretty good idea of what these executives are thinking. And obviously, with the Fed, it's going to be the same as it is with investors. You're going to be looking at what the forward-looking forecast is for earnings at these companies. And then if anybody says anything about layoffs or anything like that, right now earnings seem to be coming in okay given the situation, and the forecasts for 2025 are pretty good. So the Fed is not overly worried about recession at this point. But I will say one thing, and that is I don't want to dismiss the idea of this slowing economy too much, because we don't get the jobs report until next Friday. And if that shows 4.2%, then you trigger the Somm rule, and it scares investors, and it scares the horses, and then it maybe scares the Fed. So we have to wait and see how that turns out.
Citi thinks we hit 4.2 next week. I'm far more interested in how the market responds to this than the Federal Reserve, because the Federal Reserve knows we're close to it, and they don't seem too worried about it. Bill Dudley, the former New York Fed president, suggests that they should be. I just wonder if the market sees that, given how well-known that rule has become, particularly over the last few years, Lisa, that people begin to price in what they believe will be, with certainty in their minds, a recession.
What I find interesting is that for most of this year, the volatility was in the bond market. We saw pretty massive fluctuations. Over the past couple of weeks, yes, we've seen some real moves in the bond market, but the volatility has been in the stock market. How much will the stock market, will risk assets actually respond to a downside surprise or in that jobs report or a 4.2% unemployment report, much more than even the bond market, which is already pricing in a good deal of rate cutting?
Next to no news yesterday on Nvidia. The range down by 6.9% at the lows, the highs positive 2%. That's a massive range on one of the biggest companies on the planet. Talk about volatility.
And we've seen it index-wide, and that, I think, is sort of different. We've seen it in specific stocks, but not index-wide in the same kind of way as we have over the past couple of weeks.
Let's get to the price action, and then we'll build on this conversation on the economic side of things. Equity futures going into the opening bell in about an hour from now, positive by 0.8, on the Nasdaq up by 1%, on the Russell up by 1.4. In the bond market, we look a little something like this. Yields lower by 2 basis points on a 2-year, 440, down about 2 as well on a 10-year at 421.72. Nothing too scary in this economic data this morning. To discuss, I'm pleased to say, a good friend of this programme over the years, Mark Zandi of Moody's Analytics, joins us now for more. Mark, you think maybe we've been too high for too long at this Federal Reserve. How would you like to see this conversation change next Wednesday?
Well, I mean, at this point, Jonathan, I think September is when the Fed wants to cut and when they will cut. So I just think they're going to reaffirm that with this meeting and press conference and everything else that goes around it. So I think it's all about just confirming current market expectations. And you know, investors, you probably know better than I, but I think there's a close to 100% probability to expect a September rate cut. Today's data is consistent with that, and I think that's the language we're going to hear next week from the Fed, that they're just going to, cement that expectation.
Mark, the Fed believes they've got time, and we had this exchange with Bill Dudley. I'm sure you read his piece on Bloomberg Opinion earlier this week. The former New York Fed president suggesting that maybe they're miscalculating how much time they have, taking too much comfort away from what's developing in the labour market. As you look across the labour market, I just want to understand what's on your dashboard right now, Mark. What is concerning you? What stands out? What's sort of flashing brightly for you?
Well, I agree with Bill. I think the Fed should, I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The objective is full employment, check, 4.1% unemployment rate, and low and stable inflation. And I say check. I mean, the PCE inflation is 2.5% within spitting distance of their target, and everything is headed in the right direction. And, we've been reduced to going to the second and third significant digit here. But if you do that with today's numbers, you're right on target. And the other thing I'd say is if you exclude the implicit cost of home ownership, which I think you should do, there's growing evidence that is not really helpful in setting monetary policy. The PCE deflator is at 2% or below and has, on a year-over-year basis, has been there for more than a year. So you got to ask yourself the question, well, why a 5.5% funds rate target when you've achieved your objectives? And I'd say, if you're saying the counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? It's in the job market, what's going on in the financial system. It just strongly argues to me that the Fed should be cutting rates. But having said all of that, it looks like September. I'll take it.
Mark, one thing that we were talking to with Bill Dudley was why now? What triggered this shift in view that it is time to cut rates in possibly even next week, given that the economy is still hanging in there? And you're saying, well, why wait? Because you see enough signs of weakening. You point to something else, and that's the downward revisions in the labor market for prior months, that concerns you. Why is that important?
Well, Lisa, it's the plethora of labor market data suggests that it's downshifting in a pretty meaningful way. The downward revisions to previous payroll employment reports is consistent with that, but there's a lot of other evidence. I mean, hours worked are down, hiring rates are down, quit rates are down, temp jobs are down. The only thing that's kind of hanging in there really well is layoffs. They feel like they're ticking up a little bit, but they're low, and that's great. But, we don't have a really good theory as to why businesses are so reluctant to lay off. We've got theories, labor hoarding kind of theories, but they feel rather tenuous to me. And as we saw in the tech sector a little over a year ago, high-flying companies that are hiring boats loaded of people can turn around pretty quickly and start laying off workers pretty quickly. So, I think things can change very fast. Once they change, it's too late. It's too late. The other thing, Lisa, I'd say is it's not only about the labor market, it's about the financial system. The financial system is under a lot of pressure. The yield curve, the difference between short and long rates is still inverted, and that's a very uncomfortable place for banks and other non-bank financial institutions. You throw in weakening credit quality, slower loan growth because of the tightening and underwriting in the wake of last year's banking crisis, higher regulatory costs. The operating environment is pretty tough. And so something could break in the financial system. And as we saw from the crisis a little over a year ago, that can happen also very quickly. So why take that chance?
You're talking about things changing very fast and the potential financial pressures. We're seeing a lot of volatility in certain stocks. Some people would say it's technical. We're also seeing it in certain currency pairs. And there's been a lot of speculation about what kind of technical backdrop there is for this. Do you think that is cause to really build on your worry about a financial system that's stretched, that's seeing sort of outsized moves in response to not that significant catalyst simply because there aren't sort of the buffers that there have been in the past?
Yeah, it's a good point. I mean, my focus is more on the bond market, and you can kind of feel it there. The liquidity in the market just doesn't feel good. I mean, I've been watching the bond market for decades. You go back not too long ago, if you saw the 10-year Treasury yield move a couple, 3 basis points, you go, that's a big move. Now it's moving 10, 20 basis points in a day. I mean, in an hour. So I do think liquidity is an issue, and there's some structural problems there, right? I mean, the big broker dealers that make those markets haven't been able to or willing to expand their balance sheets to remain consistent with the growth in the amount of debt outstanding. We've got all this Treasury debt coming into the market because of the large budget deficits, But because of capital rules and liquidity rules, banks have not expanded those balance sheets, and therefore the market just feels really fragile to me in terms of liquidity. And yeah, we could get a liquidity event, and it's happened in the past, and certainly is a risk going forward.
Mark, just before you go, I've seen a lot of growth scares in financial markets over the years. I'm sure you have too. I can't think of a time when I've heard so much about the SARM rule as I have this time around. It's like everyone's talking about it in financial markets. Now, I know in your world, in the world of economics, we've been talking about this for a while, but financial market participant, investor after investor, all talking about the same thing. Mark, if we trigger that next Friday, do you think market participants, based on conversations you've been having, will begin to behave like it's here, the recession's arrived?
No, I don't think investors are slave to any one indicator, and every indicator's got its issues. I mean, the SARM's rules, it's something certainly to watch, but, obviously unemployment is ticking higher because of labor supply, right? We've got a lot of foreign immigrants coming into the country, starting to work, and that's causing the unemployment to rise. So it depends why the unemployment rate is rising. Is it labor supply, as it is today, or is it labor demand? And I think it's more supply than demand. So you have to take all these things into consideration. And I think investors are pretty smart. They do that as well. But, it's just one other indicator, along with all the other indicators I just articulated, to suggest, look, the labor market's feeling a little squishy here. And again, why take a chance? You mission accomplished. You've achieved your goals. Let's get going.
Mark Zandi. Mark, appreciate it. Let's catch up soon. Mark Zandi there of Moody's Analytics on the Federal Reserve. Next week's an interesting one. We often sit here and we say it's the most important jobs report since the last one until the next one. I do think this jobs report next Friday takes on some additional importance, don't you?
It is definitely the most important report since the last one until the next one, 100%. And I will tell you it does, because we don't have a clear sense of exactly where we are on the trajectory.
It's not like that July 4th payrolls report when everyone went to the beach and Mike McKee was stuck here breaking it down. This one feels more important.
We had fun
Mike.
without you.
I'm sure you did. How important do you think this is next Friday?
I think Lisa summed it up well. Most important since the last one, because we're going to have another one before the September meeting.
True.
So it will continue to. Although, because we're so close to the SARM rule, as you pointed out,
yeah,
it will garner interest. Unemployment has to be the first number I mention on a week from today.
I agree. I think for a lot of people, that's like the indicator next Friday. Mike, appreciate it. Thanks for today. And this week, appreciate it. Thank you. Let's get you up to speed on some stories elsewhere with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. The SEC is suing short seller Andrew Left and his Citron Capital, accusing him of committing fraud through stock trades, social media posts, and research reports. The SEC is alleging that Left and Citron generated about $20 million in illegal profits. The regulator claims that Left would make a recommendation alongside a price target and then capitalize on the resulting movements, but on prices far different than what he recommended. Left had no immediate comment. Canada has beaten New Zealand 2-1 in the Olympics women's soccer tournament, moving a step closer to a second straight gold medal. But the match has been overshadowed by an ongoing spying scandal. The Canadian Olympic Committee announced it sent the coach home after the team used drones to make unauthorized recordings of New Zealand's practices in the lead up to the match. The Canadian staff member flying the drone was arrested and given an 8-month suspended prison sentence by French authorities. And Vice President Kamala Harris is picking up another key Democratic endorsement, Barack and Michelle Obama.
Kamala.
Hello. Hi.
Hey there.
Oh, hi, you're both together. Oh, it's good to hear you both.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
Oh my goodness. Michelle, Barack, this means so much to me. I am looking forward to doing this with the two of you, Doug and I both, and getting out there, being on the road. But most of all, I just want to tell you the words you have spoken and the friendship that you have given over all these years mean more than I can express. So thank you both. It means so much. And we're going to have some fun with this too, aren't we?
Harris earlier this week secured enough pledged delegates to clinch the nomination. It caps a whirlwind week that saw Democrats coalesce around her as President Biden decided to end his candidacy. Biden quickly endorsed Harris, but Barack Obama had been holding back. A person familiar with his thinking telling Bloomberg he first wanted to give the party time to unite behind a candidate. And that's your brief, John.
Danny, thank you. Thanks for today and have a good weekend. If it was me, and obviously I'm not the vice president, but if the president called the former president, I'm sort of pausing and stopping. I'll sort of keep walking, sort of super chill.
Well, it was fantastic B-roll.
Perfectly staged.
Yeah, it was good. It was good. It worked.
Perfectly staged. Let's put it that way. Up next on the programme, setting you up for a big week ahead with a lot of tech earnings on deck, a Federal Reserve decision and a payrolls report a week away. From New York, you're watching Bloomberg Surveillance. Go on.
No, I'm good.
No? All right.
We're done.
Okay, we're done. 40 minutes away from the opening bell. Equities right now firmer by 0.7% on the S&P. Yields are lower by 2 basis points, 422.31. It's like collectively, take a deep breath. What a week, honestly, in this equity market.
I mean, to me, the weird part about this is we were talking growth scare 2 days ago. Definitely growth scare. I mean, that was basically entirely everything, and you just are seeing the confirmation everywhere. And then it was, this is a fantastic rotation. Check out those small caps. Check out high yield spreads. I mean, pick your narrative. It's like changing every day.
I think you had 4 different market regimes in the last 60 minutes of trading in yesterday's session. As we count you down to the opening bell, here's the trading diary for the week ahead. Let's get to it. Tuesday, JOLTS and consumer confidence data. Wednesday, we get the ADP report and a BOJ rate decision together with a Federal Reserve decision as well, followed by a Chairman Powell news conference at 2:30 Eastern Time. On Thursday, another round of jobless claims, and on Friday, the July payrolls report. And if you look at that calendar, just for the week ahead, for the data and the central bank decisions, given what we know now, if I could have the outcome to any of that, I'd take the payrolls report over the Fed. Given that it doesn't sound like the Fed's going to do anything on Wednesday. Based on their communication, maybe they throw in a surprise, I don't know. But based on what we know now, I'd take Friday payrolls.
I think a lot of people would agree with you. It was interesting that Victoria Fernandez of Crossmark came on here and said, actually, she has a good sense of all of it. She wants to see the Treasury refunding announcement to see exactly what maturities of Treasuries the U.S. government's going to sell. So a lot going on.
A lot of people in Camp Bramo, aren't they? Treasury refunding next week.
Do you know how many people have messaged me to be like, stay on the auctions? The
know.
auctions are important. Don't let John bully you about auctions.
John Bully, let me tell you how commercial breaks go. But not that way around.
Oh,
not that way around.
Big bully.
AMH and Bramo teaming up.
Oh, yeah.
Giving me grief.
So terrible.
Let's get to the week ahead. It looks like this. The Mag 7 results coming in thick and fast. We hear from the likes of Microsoft, Meta, Apple, and Amazon. You've got to wait until the end of August for Nvidia, and we've said it already this week that they need to change that. Mandeep Singh of Bloomberg Intelligence. Mandeep, do you agree? We need to bring that in. Why do we need to wait until the end of August for Nvidia?
Save the best for the last. So, that's been the theme for the last few quarters. But clearly, I think Microsoft is very important in terms of keeping this AI trade going, because everyone realizes Microsoft is at the forefront of both ramping up the CapEx side as well as the cloud deployment. I mean, look, this is a company that has actually got a live product, Copilot, that is generating revenue. And you want to see that AI lift in the numbers when they report next week. So I think that's the one to watch.
You framed it perfectly earlier this week, and we extended that conversation through this morning with a couple of guests as well. If you look at the reaction to earnings so far, you can start to gauge what investors are rewarding companies for and what they're punishing companies for. And the example you used was Alphabet. Can we start there? What did investors punish Alphabet for? And how do you see that setting us up for next week when we hear from the likes of Meta and the other big players?
Yeah, I mean, in the case of Alphabet, they didn't have a timeline for when these CapEx increases would go away. I mean, they are clearly spending 60 to 70% above their historical CapEx, and typically this reverts to the mean. They're not saying that because they think it's a long runway. I think Meta is going to do the same. And look, as an investor, you don't mind, companies spending, especially the companies that generate $100 billion in free cash flow like Alphabet does. So it's a good way to spend on new technology, but you do want to see the monetization. And in the case of Alphabet, the search revenue did accelerate sequentially, but it was 1 percentage point of acceleration. So clearly they're not losing any share. They have kind of reclaimed their mojo in terms of, being ahead on the search side. but you do want to see a more meaningful lift, which is what everyone is hoping Microsoft can show in the results.
So we get Microsoft, we get Meta, we get Apple, we get Amazon all next week. Of those, which do you think is going to be potentially either the biggest surprise or that you are most curious about?
I mean, Amazon, look, in the case of Amazon, especially the AWS side, everyone thinks they are behind the curve when it comes to generative AI because remember, Amazon is the largest cloud player. AWS generates $100 billion in revenue run rate. Azure is 76 and Google Cloud is 40 billion. But their growth rate seems to be decelerating. So this quarter, it's high teens. Everyone else is growing around 30%, Azure, Google Cloud. So you want to see them actually surprise to the upside just to assure investors that they're not lagging behind on the cloud side. And I think that's still uncertain.
I'm super interested in Apple. What does Apple look like in China? We've had that guide again to suggest that the iPhone's struggling a little bit in the mainland. And then Apple came out last time around and said, nothing to see here. There isn't a big problem. I just wonder if we hear the same commentary next week.
Yeah, and whether they talk about production and how much they're diversifying that and whether they talk about the Treasury refunding announcement.
Of course they will. Yeah, that will come up too. Luca Maestri, by the way, is an amazing timer of the bond market, isn't he?
By the way, I just want to point out something. All of these big tech companies have benefited so much from rates where they are because they've got so much cash. They're keeping them in T-bills.
I've seen.
And they've been absolutely cashing in. So it raises this question of what is interest rate sensitivity for some of these
How did we
things?
get back to the deficit, Treasury issuance and that with tech firms?
You're
But we
welcome.
did. OK, anytime. Mandeep, thank you. Appreciate it. Mandeep Singh there of Bloomberg Intelligence. Lisa, thank you. Appreciate it.
For what?
Anne-Marie, thank you. It's off next week, by the way. Anytime. We'll see you next week on Monday. Terry Haynes of Pangea Policy, Lindsay Piexer of Stifel, Amanda Lynham of BlackRock, Kevin Gordon of Charles Schwab. From the team here at Bloomberg Surveillance, thank you very much for choosing Bloomberg TV. And if you can, please have a wonderful weekend. This was Bloomberg Surveillance.